Welcome to Yahoo Finance Live. We're minutes away from finding out the April unemployment data. Economists are expecting a 3.6% unemployment rate and 185,000 change additions in non-farm payrolls. Let's bring in Yahoo Finance's Diane King-Hall. She's with us as we anticipate these numbers here, Diane. And we're also looking for, I just want to quickly mention the average hourly earnings number we're looking for, because there's a lot of attention on that too. 0.3% is the month-over-month number we're looking for there. But what are you kind of zeroing in on?
I mean, obviously, we're looking at the headline numbers. One data point that I found interesting in light of the coming jobs data is a chart by Morning Consult, which showed the increase in occurrence of wage loss in high-income households. So I'm definitely going to be looking at just wages in general. And they're seeing this as just a potential red flag for the economy. Now, keep in mind, high-paying tech jobs have been kind of falling to the wayside recently as companies cut back payrolls in the face of just decelerating macroeconomic conditions. And so you're seeing an uptick in the amount of high-income earners losing their income in this environment. So definitely going to be paying attention to wages. Of course, the labor participation rate as well, and you think about this also in the context of ADP's numbers out earlier this week, which were actually better than expected,
So we'll see how these look.
And since we're on the concept, not the concept, wages are a great concept. But since we're on the topic of
I'm a fan. Wages is a concept.
Big fan here. Pro wages. At the end of the day, too, there's another way to kind of continue to parse through what the Fed has said about wages, even coming into this, and where wages are really factored into the costs that different employers are having to put into the consumption market as well. So wages on that front, Fed Chair Jay Powell had said over the course of this week, at least during this press conference, we've seen that wage number from late last week, and whenever it was, he said it's a couple of percentage points above what would be consistent with 2% inflation over time. And so with that wage number, it's amazingly important to continue to see what the Fed says about that within all of their policy decisions to this point in time. But that wage number still running hot against the inflation backdrop that they are trying to combat at this point in time.
Yeah, of course. I mean, as we talk about perspective, I'm looking at a chart from Goldman Sachs, which zeroed in on the JOLTS data that we got earlier in the week. Feels like last week. Earlier in the week, which showed that there was a bigger than expected drop in that JOLTS data, the job openings, right? But Goldman also looks at what they call a range of alternative openings measures. So not just JOLTS, but other ways to measure how many openings there are. That's the kind of a graph that you see there that shows more of that range. But what's interesting is, although obviously there's a very clear declining trend here in job openings, it's much higher than it was still, than it was in the trough of this cycle, but also in 2019. So we are still seeing that higher relative pace of job openings, job availability, and overall the job market. So even though we're falling from that elevated level, we're still not going back to where we were.
It's true. I mean, there's still strength in the job market. All the analysts that we talk to talk about that with regard to, other economic indicators decelerating, but the job market remains robust in general, whether we're talking about job gains. Again, we had those ADP numbers that came out earlier this week, and they're often looked to as a precursor to today's jobs report, the monthly jobs report from the government, and that was a gain of 296,000. That's private sector payrolls. Obviously, that was better than expected, but sometimes we know those numbers diverge. They don't always meet in the middle.
Right, and ADP had to adjust their methodology last year just to attempt to try and get a little bit closer to what the actuality is. And of course, it's looking across private payrolls here. A couple of sectors to keep in mind going into this report too. Contextually, we continued to see the most growth, leisure and hospitality, as that continues to come back from the onset of the pandemic. But government and professional and business services as well, those could be interesting to track, especially given the trend of layoffs that we had seen in professional and business services. And so just keep a close eye on some of those sectors as we go into getting these figures as they drop in just a few seconds.
Yeah, in just a few seconds. And let's just give you quickly again, the estimates here. 185,000 is the number we're looking for non-farm payrolls. The unemployment rate at 3.6%. Average hourly earnings month over month estimated at 0.3%. By the way, we have underestimated this number for 12 straight months. So taking a look here at the numbers as we do get them, 253,000. Guess what? It's the 13th straight month now that these numbers have been below. 253,000 jobs added to the U.S. economy last month versus 185,000 that were estimated. The unemployment rate falling, folks. 3.4%. That is 2 ticks below what economists had been estimating. Average hourly earnings hot, 0.5% month over month, 4.4% year over year. So again, just wanted to run through these numbers quickly. 253,000 jobs added to the U.S. economy last month, above the 185,000 that were estimated. 3.4% unemployment rate, so that is down 0.1% month over month. Average hourly earnings rising 0.5% month over month. So this is not good news for people who are looking for the Federal Reserve to cut rates this year.
Right.
Why? Because this is showing A, a robust job market, but B, that wage growth, it's still happening.
It is. I mean, in general, I mean, and what you just talked about is leisure and hospitality. We're seeing growth there, gains there, and also even professional and business services. You saw gains there in that sector. So that's actually surprising to me, that piece, the professional and business services. So it just reiterates what we've heard from economists and analysts, that the labor market does still continue to just be robust. Even the data we saw earlier this week, although there was some change in the direction of JOLTS, that was still strong as well. So certainly seeing by the numbers that the job market remains strong.
Yeah, we're sitting over the past 6 months at least at an average monthly gain of 290,000 jobs here. Now, in this most recent report as well from the BLS, employment trending up. You mentioned those sectors, professional business services, just to put some numbers on this, 43,000 jobs added there. And then additionally, the average monthly gain in that industry was 25,000. So that is running hot against the 6-month monthly average. In professional, scientific, technical services, 45,000 jobs there. But healthcare, that increased by 40,000 in April. You compare that to the 47,000 average over the past 6 months as well. And then leisure and hospitality, that was up by about 31,000 jobs in April here. There's usually some context that gets added within this report about leisure and hospitality, given that it was the hardest hit on the onset of the pandemic. And we got that from the BLS. Employment in this industry, it still remains below its pre-pandemic February 2020 level by about 402,000 jobs. So that's about 2.4% right now.
Yeah, and let's take a look at how markets are reacting to all of this. If you take a look at the Wi-Fi Interactive, I'd actually like to start with what's going on in bonds, right? This is Treasury futures you're looking at right here. So we do tend to see, right, bond prices, not tend to see, this is what we see, bond prices and yields move inversely. This is the price of the 10-year futures going down. That means yields are moving sharply higher in reaction to this jobs report. We also, of course, want to look at what's going on in stock futures. Dow futures not seeing a lot of reaction here. S&P futures still higher, but not, again, seeing a huge reaction. And the same goes for the Nasdaq futures, seeing a little bit of a leg down there on your screen, but not seeing an enormous reaction here as people try to tease out what this means. I mean, I think it's notable that movement in the Treasury market, that idea that rates moving higher is the effect of what you're seeing overall from this jobs report.
Yeah.
Because the Fed has not succeeded enough, as much as it wants to, in slowing down the U.S. economy.
And so I expect by June, at most, we'd see a pause. You know, that had been, as Fed Chair Jerome Powell said in the last meeting, that there had been talk of a pause, but obviously that didn't come up in the meeting this week.
Does this even put another increce?
Exactly.
On the table.
Play.
I mean, we've got other data in between now and then, and we're going to talk about that much more throughout the next couple of hours. But I think that potentially that puts that in play.
Well, we're inside of an hour until the start of trade here on the day. Yahoo Finance's own Diane King-Hall joining us to break down some of the job numbers this morning. Thanks so much, Diane. Also here, everyone, let's just recap these numbers very briefly here. You're taking a look at the April jobs report. 253,000 jobs were added during the month of April. Unemployment rate That came in at 3.4%. The expectation was for 3.6%. So that better than expected, but it'll be interesting to see how the Fed evaluates that. Also, the average hourly wages year over year, they went up by about 4.4%. And so for more and a deeper dive into these numbers, let's bring in Lauren Goodwin, who is the New York Life Investments economist and portfolio strategist, along with EY chief economist Greg Dacko. Great to have you both here with us this morning. Okay, so if you're the Fed and your Fed Chair Jay Powell, I always paint this picture of him sipping his tea, looking at these numbers as they drop here. I don't know what he's drinking this morning, but what do you imagine he's thinking as you see the unemployment rate at 3.4% now, and you clearly still have more cushion on the employment side of the equation in your dual mandate to continue combating inflation here?
Well, I'm a tea drinker, so I like to think he's drinking tea as well. This is a really complicated number for the Fed because we know, and this, you've done a great job on this program laying out that the labor market is a lagging indicator. When the Fed starts raising interest rates, it takes time for dominoes to topple. You first see them in interest rate sensitive sectors, then in manufacturing, then in services, and only then in the labor market. And tightening credit conditions from what's been happening in the banking sector, that should be adding a little bit of wind to these dominoes and should be impacting hiring intentions in the labor market. But they haven't seen it yet. I read the meeting and the press conference on Wednesday to say that the Fed, having had a bias towards hiking in the last year, had moved towards a bias to sit still. But this data is challenging for that perspective.
Does it bring June back on the table, Greg?
I think it very much does, and that's problematic, I think, in the current environment. We are in a situation where we are seeing signs of an economic slowdown if you look forward. If you look backwards, we're not necessarily seeing all the signs of that slowdown materializing. But what the Fed did with the hawkish pause earlier this week is essentially signal that it's still willing to raise rates if necessary. It wants to pause, but it's still willing to raise rates if necessary. I think, unfortunately, this latest data reading is going to be one that favors one further rate hike. That might be a mistake in the current environment where we're seeing increased bank stress.
Certainly. And so, yeah, with the increased bank stress, and it's been a whole 24 hours since we talked about that, but, you know, as we think about just what the Fed's policy pathway has been to this point and how even within the wage side of the equation that they have to think about, because we just heard commentary from Fed Chair Jay Powell commenting on wages and how that correlation to inflation continues to be a headwind that they have to be concerned about right now. What do you do off of this report?
Well, I think what you have to do is really look at what the momentum is going to be going into the rest of the year. You can't just focus on data dependence. Extreme data dependence in an environment that is as volatile as today provides the lack of an anchor for monetary policy. And that's really what we need today. We need to be looking at the broad range of indicators that are showing that the disinflationary currents are gaining momentum. You look at consumer prices, producer prices, import prices, and even wages. We know they're volatile, so I wouldn't take one reading as being the final read. There is sign that there is a moderation in inflationary dynamics. That means that the Fed has the leisure to pause, look at the lags of monetary policy and the effects on the economy, and be careful not to be too tone deaf to what's happening on the banking sector front, because that has immediate implication for the banking sector, but indirect implications in terms of credit and economic activity going forward.
Just one quick note I want to make, and we did get revisions, by the way, for the prior month, and we got a downward revision to 165,000 from 236,000. So that's just something to take note of as we look at the trend of these numbers, and also as we talk about how they keep overshooting. That one, obviously, if it's revised lower, it wasn't quite the same magnitude. Lauren, I guess then the question becomes, is the Fed measuring the wrong things? Is the Fed data dependent on the wrong data?
I don't think so. We all have the same data. Everybody's doing the best that they can with this information, right? And the reality is that for the Fed and for everybody else, that the environment is really challenging to forecast. I think, frankly, that's true in any economic cycle. This cycle has its own flavors and differences, but late in the economic cycle, this balance between rising financial stability and economic risks with persistent wage growth and employment environment is actually pretty standard. It's just hard to thread the needle in this phase of the cycle. And I point to actually the last 10 recessions. In 9 out of the last 10, and on average, payrolls are looking really strong until the moment we are in recession. And so I couldn't agree with Greg more that when you get to this sort of late stage in the economic cycle, it's really important to pull back and acknowledge that the data doesn't tell us everything.
And so with that in mind, I mean, we've heard from bank CEOs over the course of this earnings season, recession Q3 2023. Does this report say that at all?
Again, it doesn't necessarily say no to that. I think
it won't until it does.
Right. Yeah. And it's one of the most important, I think, pushbacks to the perspective that how could we be in recession when the labor market is so strong? Again, historically, that tends to be true, that the labor market is incredibly resilient until the moment we are already in recession. And by the way, same for the market. There's this perception that the market tends to anticipate recessions, and historically that just doesn't bear out. The market does tend to lead the economy out of recession, but heading in, you have to see a fallout in employment outcomes. You have to see a decline in outright earnings growth. You have to see recession already happening before the market really takes that into account.
We did actually see one element that I think is noteworthy, but it's in the weeds, it's for the data nerds, but the diffusion of job growth. So what share of private sector occupations saw job gains is at the weakest in multiple years. 57% of jobs only rose. That's a very low number. That's important to keep in mind because it's the breadth of job growth that also matters. If it's one or two sectors, as Lauren was saying, these can be shut off from 1 month to the next. And we've seen that the labor market dynamics are very different than what they've been in the past. It's a hiring slowdown that has led the way, and now we're starting to see job cuts. These are non-linear job cuts. It's not all linear.
Well, and one of the points that the Goldman economists made in their preview note was that as we start to see contraction of credit, that's going to affect some sectors more than others because some sectors borrow more than others. Labor and hospitality is a sector, they say, that tends to borrow a lot. So even though that's been one of the most strongest areas, could that see some pullback? So I guess to go back to another point that I was making and that you were talking about earlier, if this does put June back on the table, there are so many people now who are like, the Fed should not keep raising, the Fed needs to cut, we are in danger zone here. If June is back on the table, what's the risk if the Fed keeps hiking in this kind of environment?
Well, I think the risk, we're seeing it today. We're seeing increased banking sector stress on smaller regional banks, and there is a consolidation underway. I think some of the commentary that Powell made during the press conference a couple of days ago showed that there was perhaps not as much concern as others have highlighted in terms of the regional banking sector. And we are likely to see further stress down the road. So as the Fed continues to raise rate in this type of environment, it will increase pressures. Let's not forget, again, in an environment where inflation is slowing, that's putting upward pressure on real rates, the real cost of capital, and that is deterring business activity. So we are going to be in this environment going forward where we're going to see the slowdown in interest rate sensitive sectors and other sectors that are dependent on that. So that slowdown in inflation is materializing. Do you need to do much more? I'm not so sure at this juncture. Let's not forget 2019 or even during the COVID crisis, the Fed was a little bit late in assessing that there was this slowdown. Let's not repeat the mistakes of the past.
To pick up on something about regional banks real quick, since you mentioned it, how much of the issue at regional banks is real and how much is perception on the part of the market, given the activity we've seen over the past few days?
I think we've seen a transition in that dynamic this week because many of the banks that have been failing in the earlier days in March had what have been widely described as idiosyncratic issues. But the reality is that these banks' business models were much more sensitive and perhaps not mitigated from a risk perspective to the rise in interest rates. And whether it's the pace or the level of interest rates is unfortunately immaterial at this point. What we've seen this week is banks that are strong franchises that had strong levels of deposits reporting earnings in just the recent weeks. Again, looking pretty good and experiencing a slow run on the banks from the market, a confidence issue. That is not the Fed's goal. But what I will say is that slowing the economy And understanding that interest rate sensitive business models, as Greg is pointing out, are going to be experiencing this slowdown is the express purpose of raising interest rates in this environment. Cutting inflation off at the knees is, the Fed perceives, the most important thing for the long-term health of the economy. That's why Powell keeps saying over and over, without price stability, the economy works for no one. And so while, of course, seeing layoffs in certain sectors, and especially concentrated layoffs, seeing banks fail is not what anybody wants to see. The Fed can't come out and say, like, this is the point of this policy, right. But this is the point of this policy, is to accelerate the disinflationary process that we've only just started seeing.
Just want to bring this to people's portfolios. If you are waking up this morning, you read this report, you're trying to anticipate how the Fed is going to perceive it as well, and how this changes their calculus, what's the first trade you make this morning?
A couple of things to keep in mind for investors. The first is that the very cause of this wailing, gnashing of teeth and volatility is also an incredible opportunity for investors for the first time in a very long time. We have been relying on price appreciation for 15 years to add value to a portfolio, and the income generation aspect of portfolio allocation is back. That is so important. And most investors are over allocated to stocks. And so a reallocation in a portfolio to bonds in many cases makes sense. Taking advantage of higher yield and what we expect to be a more moderate yield and inflation macroeconomic environment ahead. Another thing that I think investors can consider is that because there's a lot of volatility and risks are rising, it can be easy to run for the hills. But this Fed pause window that we may be entering soon also enters an opportunity for, frankly, if not just a sideways market, some real positive upside days. So staying invested and thinking creatively about what defensive sectors mean. The digital infrastructure, energy infrastructure, the sectors of the economy that are benefiting from more global macroeconomic trends, there are opportunities out there in the market, and it's important to stay focused on sort of keeping to your plan.
Guys, thanks so much. This was fun.
Thank you.
Appreciate it. Lauren Goodwin, New York Life Investments portfolio manager and economist, and EY chief economist Greg Dacko. Thanks to you both. Appreciate it. All right, let's do a quick recap of the numbers here, as we did get these stronger than anticipated numbers from the Labor Department. 253,000 jobs added to the U.S. economy last month, ahead of the 185,000 estimated 3.4% the unemployment rate, and average hourly earnings going up 4.4% on a year-over-year basis. Coming up, we're going to get a pulse check on the labor market from a staffing perspective. Stay with us. Welcome back. We just got a hotter than estimated jobs report again. And so let's take a look at how that is playing out in the markets here. We've got S&P futures that took a little teeny leg lower and now are higher by 0.8%, so higher than where they were before the numbers came out. We are seeing, if we look at the other major averages in the futures that track them, similar activity here, less so for the Nasdaq 100, which of course is most interest rate sensitive. And what's happening with interest rates? Guess what? They're going higher. This is the price of Treasury futures. That means that yields are going up. And we definitely have seen an inverse relationship, in particular between the Nasdaq and rates. Of course, if you look on the shorter end of the curve, here's the 2-year futures. We are seeing similar activity there. Let's also get a check on what's happening in the pre-market when it comes to some individual stocks, if we can get them. I want to take a look at the pre-market action here. Apple, which of course we'll get to later, following its earnings, is up 2.7% in pre-market trading. And I'm seeing a lot of green, the lower numbers here on the screen from large cap tech, interestingly here with this strong jobs report. Nvidia, for example, up 0.75%. Microsoft up a little less than 0.5% in pre-market trading. So we are not seeing, even though the Nasdaq 100 futures did not react as strongly, we are seeing large cap tech that's actually higher in pre-market trading. And actually, let me check on one more thing that I want to take a look at here this morning, just because it has been in such focus lately, and that's crude oil futures, which we have really seen take some big down legs lately. Today, it is still higher after this jobs report, up 2.7% to, let's see, just over $70 a barrel here. Looking quickly at the 6-day chart, though, we still see that slump in oil. Let's get back to jobs here and look at it from a staffing perspective. Recruitment agency Adecco says we are still in a candidate-driven market. Let's bring in Adecco Senior Vice President Amy Glazer for perspective. Amy, what does that mean, a candidate-driven market? Explain to us.
So the candidates still are at the forefront. You know, whether it be a year ago when we had 2 jobs for every job seeker, or even today where we see the number of job openings have declined slightly, there still isn't a one-to-one match, and there are more job opportunities out there than folks actually looking for work.
And so there are plenty of people who, in the categories that are continuing to see growth right now, as BLS continues to give us an update even on leisure and hospitality and that trying to get back to its pre-pandemic levels, where are you seeing the conversations around wages move forward right now?
Good question. We're still seeing a strong appetite for wage increases in those hot on-demand jobs, especially among the hourly workers. So think leisure, hospitality, think retail, warehouse. We're still seeing quite a bit of an uptick there. What we are seeing is a new trend is last year was the year of the sign-on bonus, retention bonuses, all types of creative ways of supplementing for a total compensation package. And we're seeing employers really put that in the base wage rate now. So I do continue to see, especially among that hourly workforce, a rise in wages.
That's really interesting, Amy. Is that something that is more appealing? Like the people who are looking for jobs, would they rather see it in the base versus a bonus? Like what are the various pros and cons, and why are employers doing it in a different way?
Yeah, I think right now, given a lot of the uncertainty, people are looking for short-term satisfaction and ensurement that they're going to be able to heat and eat over what's remaining of the winter and as they get ready to come into summer. So we're seeing that short-term mentality of the base wage rate, as opposed to being really looking for that carrot dangling in the future, being something that's driving candidates as they're choosing which employer they're going to go work for.
Are you seeing any type of kind of preference given to a type of employer based on where they're allowing their workforce to really occupy the role from? And I'm thinking about virtual employment. I'm thinking about how many people have opted for the ability to just be employed from anywhere at this point.
You know, I think we're seeing the greatest appetite, both from an employer and a candidate perspective, is this notion of hybrid work. Mm-hmm. So people yearn to be around other people and are really looking for that opportunity to collaborate, gain synergies, the good old, coffee talk, but they don't want to do it 5 days a week. So employers who are affording that level of flexibility for coming into the office 2 or 3 days a week are really getting a leg up and kind of seeing the best of both worlds. I would say from a more blue collar workspace, the candidates are really looking for flexibility and part-time work is on the rise. I was sitting in Ohio in one of our offices this week, and I watched about 8 candidates come in, and 3 of the 8 were there simply looking for part-time work.
You mentioned some of the areas of strength here, manufacturing, warehouse, call center. Are there any areas where you are starting to see less demand?
I think we continue to see within the technology sector just that right sizing of what was a really hot labor market. I think the good news is, you have to look pocket by pocket, region by region, industry by industry, but there are still tons of opportunities out there. And despite all the headlines about layoffs and fear of a recession, we're still seeing a ton of movement in the job market. And those that are unfortunately experiencing a loss of a job are rebounding very quickly. And we're seeing the redeployment, unlike we've seen in the past. It's not so much of a taboo anymore to share that you've been laid off. And through social media and other networks, we're really seeing them find new opportunities quickly.
Amy, just lastly, while we have you here, the New York Fed had looked at labor force participation rate data and kind of taken out what certain age or adjusted for age and retirements as well, and found that the labor force participation rate is actually above its pre-pandemic highs. So based on that data, if we're thinking about the sectors that are poised to see the most retirements or workforce or labor force participation exits, which ones would you be keeping an eye on there?
I think this is one of my favorite hot topics right now, and the automotive industry specifically is really seeing the benefits of retirees returning to work. So we're noting that about 1 in every 6 retiree is looking to return to the workforce. So I think those that required skilled trades and openings that are much harder to fill are seeking the benefit of bringing back some of that skilled workforce. So I think in the automotive manufacturing sectors, that's going to be a trend we continue to see.
Really interesting. Adecco SVP Amy Glazer. Amy, thanks so much for taking the time here this morning. Appreciate it.
My pleasure. Thank you.
Absolutely. Everyone, let's do a quick recap of the jobs numbers before we hit 9 a.m. And taking a look at the non-farm payrolls, of course, the number there, 253,000 jobs. Julie won our little prediction before the show. 253,000 jobs added during the month of April. Unemployment rate that came in at 3.4%, and the average hourly wages. That's hit 4.4% year over year. Coming up, despite back-to-back quarters of falling revenue, there were some bright spots in Apple's earnings. We're going to discuss that next.
Welcome to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's get right to the three things you need to know. First thing you need to know, of course, 253,000 jobs were added to the economy last month, with the unemployment rate coming in ahead of expectations, better than expected at 3.4%. This unexpected rebound comes after growth in March marked the lowest monthly gain since 2020. Second thing you need to know, Apple managed to beat expectations in the second quarter despite macroeconomic headwinds and trouble in the PC market. The tech giant's overall revenue dropped 3%, marking a second quarter of declining sales, but a surprise growth in its iPhone business helped drive momentum along with its strong services unit. On the earnings call, Apple CEO Tim Cook spotlighted growth in India as the company continues to invest heavily in emerging markets, and that one in particular. Third thing you need to know, Lyft beat on earnings in the first quarter, but its gloomy outlook overshadowed investor sentiment. The company's second quarter revenue forecast came in well below what the street was expecting, which sent the shares plunging, and they're still falling this morning. The stock's been on a downturn the past year as the company looks to steal back market share from rival Uber, which continues to eat into Lyft's customer base.
April's unemployment report shows a robust job market and continued wage growth, which may not be good news for people who are looking for the Fed to cut rates. That brings us to Yahoo Finance's Jennifer Schonberger with what this jobs data means for the Fed's path ahead. Jen?
Good morning, Brad. The latest jobs report showing the job market remains strong. You saw the unemployment rate drop. You saw average hourly earnings actually tick up month over month, year over year, came in higher than expected. And of course, that non-farm payrolls number clocking in higher than expected. All of this likely to influence the Fed to nudge rates a bit higher. And you saw them keep their options open in the policy meeting this week. And rightly so, given the data that we're seeing come in this morning. The Fed really wants to see a slowdown in the job market, and this report's still showing strength. The Fed sees bringing down inflation by slowing down the job market. Officials believe the strength in the job market is feeding inflation higher, both in terms of sheer number of jobs created and wage growth. So if the job market is too strong, the Fed will move to push rates higher to slow down job growth to bring down inflation. Now, they are particularly attuned to that so-called services inflation excluding shelter, and this one tends to be closely tied to labor costs. It remains particularly elevated, and it would require wage pressures to ease more. And we saw really the opposite of that in this jobs report. So all in all, the non-farm payroll number coming in at 253,000, certainly a slowdown in strength from what we saw earlier this year, but perhaps not enough of a slowdown. Because if you look at the Fed's dual mandate, they've got the job side of the equation and they've got the inflation side. The job side clearly hanging in despite 10 consecutive rate hikes over the past year, which means that leaves room for the Fed to potentially nudge the Fed funds rate maybe one or two more times here if they feel the need to do that. And I will get more insight from the Fed themselves when I sit down with Chicago Fed President Austin Goolsbee Monday morning at 11 a.m.
Awesome. I'm looking forward to that, Jen. I keep hitting refresh on my CME Fed Watch tool to see if what people are pricing in for June. And it keeps moving around, but there is
it's very volatile.
Yes, of course. But there is a small chance being priced in now of another increase at the June meeting. Right now, it's 3.9%. It was as high as 8.5% right after the numbers. I'm sure that's something you're going to talk to Austin about, but it's interesting. That was something that a lot of people had taken off the table.
Yeah, I wouldn't be surprised on the back of this number. Like I said, that wage growth really coming in much stronger than expected, driving the bus on this. And Goolsbee is interesting because going into the last meeting, he actually thought that the Fed should move more cautiously, though he voted in favor of that 25 basis point rate hike. We'll see where he stands now on the back of this data.
We will. I'm looking forward to that conversation. Thanks, Jen. Well, Apple beat on earnings in the second quarter as a surprise growth in its iPhone business and strong services unit helped drive momentum. On the earnings call, Apple CEO Tim Cook expressed major optimism on the outlook for India and emerging markets in particular.
Looking at the business in India, we did set a quarterly record and grew very strong double digits year over year. So it was quite a good quarter for us. Taking a step back, India is an incredibly exciting market. It's a major focus for us. I was just there, and the dynamism in the market, the vibrancy is unbelievable.
And let's bring in TD Cowen Managing Director Krish Sankar to discuss all things Apple. Krish, it's good to see you. I know there's a lot to talk about, but let's just start on what we just heard Tim Cook saying, since we just played that clip of him talking about India. Obviously, Apple's investing a lot in India, in manufacturing. The market there, though, in terms of consumers actually buying iPhones, is not certainly where Apple would want it to be. Do you think that this emphasis is correct on the part of Apple?
Yeah, hi, thanks for having me. I would say the emphasis makes a lot of sense. It started with, kind of think of it as a little bit of like onboarding some of the supply chain away from China. For example, Foxconn, who's the maker of iPhones for Apple, has a facility in India. That kind of helped Apple avoid some excise duties in India, so it lowered the cost of manufacturing in India, and also de-risked the supply chain. And then what you're seeing now is kind of like the natural evolution of that, which is like going on from manufacturing to having a retail store out there, because it is a big market. It's kind of like, you could argue that like China 10 years ago or whatever it might be, and that has huge potential. I would say that it does skew more towards the lower end of the phones today, but there's a potential that it could move more towards like the premium models on the hardware side and eventually get more traction on the services also for Apple.
Yeah, it sounded like they were really banking on or hoping that the growth of the middle class in India would push some of those consumers towards the more premium models. But for right now, and what you're mentioning and seeing in the pricing landscape and where consumers in the region are gravitating to lower cost models, does Apple have a secondary market problem on its hands in the region while it's trying to break into India and take on more market share?
I don't think they necessarily have a secondary market problem. I would say, like I mentioned earlier, I think one of the issues they had in the past was the iPhones used to be very highly priced in India. For example, it was always cheaper to get a phone in the US and take it to India than actually buying one in India. And a lot of that was because the manufacturing was not happening in India. It was imported from Foxconn in China, and there was an excise duty added to it. I think it was like somewhere in the range of 25% or something. So now you eliminate that excise duty because you're manufacturing domestically. So that automatically helps you keep the cost down. I think the bigger question of will the market there or the customer demand migrate from lower end to premium models, I think it's a fair enough question. It does skew towards the lower end, but I think there's a potential, as Tim Cook explained, that as the middle class grows and gets bigger and larger, there's a potential that they would start gravitating more towards the higher end or the premium models like the iPhone Pro and the Pro Max.
To sort of zoom out a little bit, Krish, how long will Apple investors have to wait for sort of another leg of growth, another growth driver? I mean, the India proposition is a longer term proposition, really. So over the near term, is it something that we see reaccelerate this year, next year, and what's going to be the catalyst for that reacceleration?
Yeah, I know it's kind of interesting. I think that's kind of been a question, I would say, for the better part of the last 5 to 10 years. Yeah. The argument has always been that, the iPhone was kind of a home run. They never had anything since then. But the flip side is, if you see, the iPhone is a very sticky install base, so that definitely helps them, monetize a lot of those install base users, and that can help actually fund growth in the non-iPhone business, which has been largely targeted towards the services. Now, keep in mind, some of the new product introduction, for example, AirPods, which came out a few years ago, quickly grew into like a $15 billion revenue business. And I think where people tend to mistake it is the fact that, there is no single home run kind of a product for Apple, but there are multiple different avenues which help the company continue to grow. Whether you look at services is actually a confluence of music, Apple Care, Apple Pay, gaming downloads, Google Tag, advertising, etc. So there are multiple vectors there. And also on the hardware side, besides the iPhone, you do have, the AirPods, the watch, the Mac, the iPads, etc. So I would say that besides the iPhone, there is no one single home run. But if you add all of the remaining together, you've seen the company grow from being like, a few hundred billion in revenue a few years ago to almost 400 billion in revenue today.
Krish, all earnings season, we've been listening to these calls from the tech CEOs and I mean, even some CEOs outside of tech that have talked about AI. And for Apple, it wasn't something that was part of their talking points or their prepared remarks. They had to get asked about it, and at which point Tim Cook essentially said, yeah, we're keeping an eye on it. There's a lot of issues to be sorted out, but they view AI as a huge kind of weaving into products, opportunity and weaving that into products on a thoughtful basis. What does that signal to you about how Apple is going to kind of keep doing its own thing and wait to see how the market responds to AI?
Yeah, it's a good question. Apple historically has been more, I would say, call it risk averse in terms of introducing new technology. When you go back to iPhone, some of the incremental technology benefits they added they were not the first to do it. And a lot of that is because they do tend to make sure that the technology is solid when they try to put it together in either the 100 millions of devices, etc. So I think from that standpoint, I think Tim Cook's answer is probably I would say the right way of looking at it, which is they probably have a program, they probably are doing something. There's nothing to talk about it today. There's been rumors that they might start using some AI in their healthcare offering. So it's kind of I think they do have a lot of opportunities, but Apple has historically never spoken about new products and or used a brand new technology unless they feel like it's not going to impact their bread and butter business.
So when we're looking across the different segments right now for Apple, you mentioned services. Services was one of the only segments that actually saw growth year over year. The other one was the iPhone. So in this time period of macroeconomic challenges that they talked about on the call, how much further out do you foresee that being a larger issue for the segments like Mac, segments like iPad, and wearables even?
Sure. It's interesting because I think services has held up pretty well. The argument is always that as you kind of go into a recession or a slowdown, people are going to start getting more frugal and they're going to start trimming, paying $3 for that service or $5, $5.99 for monthly service for something else. You really haven't seen that quite happen. I think where you're seeing the weakness in service has been more on the digital advertising side and some gaming. So that's kind of more, I would say, not a consumer-related impact, but more of a bigger picture impact. The second one is in terms of the iPad and the Mac slowdown. Keep in mind, they did have, I think it's going against tough compares last year. They did have a brand new model. And then also on the Mac, they kind of came out with their, in-house chip, like the M3, M4, MX, instead of using Intel chips anymore. So I think that kind of drove a huge surge last year. So you're kind of going against that compared today. But in general, I would say that the iPhone and the services have sounded to be much more resilient than people thought. In fact, part of the pushback I get from investors is the bear thesis, which is when you head into the second half of this year, people do worry about iPhone numbers. And the reason is that if you look at financial services and tech companies laying off a lot of employees, those are typically the iPhone purchasers, and people do worry that there's a risk of iPhone slowdown in the back half. We haven't seen any of that yet. Obviously, we do not have the visibility into back half yet, but at the same time, that's one big concern some investors have.
All right, well, with the resilient services business, maybe they should start a dating app service next, perhaps. We'll see. We'll call it Blue Bubble or something like that. I don't know. TD Cowen, Managing Director, Krish Sankar, thanks so much for joining us this morning. Appreciate it.
Thank you.
Yep. Earnings season full swing. 85% of S&P 500 companies reporting Q1 earnings so far. Earnings are down 1.3% with sales growth rising 3.8% according to data from Evercore ISI. And we're watching one company in particular today, Lyft investors. They are slamming on the brakes this morning with shares plummeting 15% ahead of the opening bell. The ride-sharing company posted a beat for the first quarter but fell short on revenue expectations, forecasting between $1 billion to $1.02 billion, where analysts were expecting $1.08 billion.
Well, investors looking at a potential pause in the Fed's rate hike following the continued pressures in the banking industry, but economic data, like today's jobs report, still remains a key player in the Fed's policy decisions. Here with how investors can position in anticipation of the Fed's next moves is Jordan Jackson, JP Morgan Asset Management Global Market Strategist. So now we may be in a pause environment, Jordan, right? Although I guess there's a little bit of question after today. So what does that mean for investors sort of operating with a pause now instead of this rising rate environment?
Sure. So we've looked at some of the numbers in terms of historically how markets have performed after that last Fed rate hike. And we've looked over the last 5 to 6 rate hiking cycles. And it's sort of in line with what one would expect in terms of the Fed pausing in an environment in which the economy is beginning to come under pressure. You tend to see long duration outperform short duration. You tend to see high quality outperform low quality. And so you tend to see defensives outperform cyclicals. And so that's very much how we continue to position portfolios today. Certainly today's report raises the risk that the Fed either could keep going or actually at least not cut rates, right, in the back half of this year, pushing against market expectations. I think investors have to be very careful here, though. The labor market is always the last shoe to drop when we think about broader economic activity and whether the economy is coming under pressure. You did see significant downward revisions in job growth over the last 2 months. Yes, I know the wage inflation number came in certainly hotter than anticipated, but the banking stress is going to feed its way into the labor market, and I think in a couple of months here, maybe in a couple of quarters. Right. The majority of the labor force is employed by companies that have 500 or fewer employees. And most of those companies bank at regional banks. And a lot of these regional banks are coming under significant pressure. And so these businesses are facing higher cost of credit, a more restrictive availability of credit. I think that's going to lead into some broader weakness in the labor market. And so another rate hike, I'm not welcoming that from the Fed.
So if the employment situation data is the last shoe to drop, Jordan, is there other data? Are there other places that investors can look to get a better pulse of where we stand, and especially with the calls that we've seen for a recession in Q3 of 2023, to best position themselves to be even defensive, as you were mentioning?
There's certain labor market indicators that are somewhat forward-looking. The quits rate in the JOLTS report tends to be a decent indicator. Elsewhere, when you look at things like new orders relative to inventories and in the PMI data, that would suggest that things are beginning to roll over. The Conference Board's leading economic indicator has also continued to signal a contraction in the quarters ahead. And I think the Fed, looks at all this for sure, but there's an issue that I have of them being laser focused on one number, and that's the inflation number. And I think the inflation is going to continue to gradually move lower. Yes, we did see a modest pop in the wage figure this morning, but I think that we're still on a downward trend, and particularly as I highlighted, the banking stresses certainly should lead to some broader weakness in the labor markets, again, as that availability and cost of credit become more restrictive.
I do want to ask you about those banking stresses a little further, Jordan, because obviously we have seen a plunge in the regional banks this week and maybe dashing hopes of folks who said that the worst of this was over. Do we have to reassess that? And I keep trying to figure out, as we see investors, yes, they're buying this morning, but we've seen them selling this week, if there are really fundamental issues at these banks, or if it's hysteria, or, I'm just trying to figure out what is really going on here.
I think there is some fundamental issues, right? Many of these banks are subject to interest rates, and we've seen the fastest rate hiking cycle since the 1980 tightening coming from the Fed. And so they've got it. There's this conundrum where they're forced to either pay more in deposits or see deposits fly out. And then on their asset side, a lot of their bond and securities holdings are losing value. So that creates a big challenge. And I think what we've gone from is, maybe acute stress to a slow burn. And so I think a lot of investors are looking across the banking spectrum. They're looking at what are potential losses on unrealized securities holdings. They're looking at deposit flows, and they're trying to assess just how much painful this could really be. But again, the stresses are very much on other small and regional banks. We're actually seeing certain larger banks are actually seeing deposits increase and kind of capturing some of those outflows. So again, I think this is more of a slow burn. Investors will continue to remain focused on the small and regional banking sector, but I think there may be a little bit more pain to come.
Jordan, as we've continued to watch the CME FedWatch tool kind of bounce around here today, at least in the figure for where a hike has re-entered the conversation as well, or re-entered the chat, there's kind of this inclination to think about, well, you've still got the outsized probability that the Fed will pause. If the Fed does pause, are we likely to see kind of just sideways trading for the extent of time that they decide to just monitor where the economy has digested some of the rate policy that they've enacted and QT that they've put forward at this point?
I think so. I think it's going to be a very volatile market. I think it's going to be a very choppy market. Investors are going to be focused maybe a little bit more on what our earnings going to do, how the broader economy is going to perform, inflation data as well. And so to some extent, it removes a bit of volatility if the Fed is willing to stay on pause. If they become active again, that might bring renewed volatility both to the bond market as well as the equity market as they try to make sense of what the trajectory is likely going to look like. And so I think, markets are going to be pretty choppy. Again, as I've highlighted at the outset of the talk here, I think you want to stay defensive, right? The economy is coming under some clear pressure. Consumers are coming under pressure as well. I know the consumption numbers in the first quarter were quite strong, but a lot of that was driven by, most of that pop was driven by generous bump in Social Security payments in the month of January and a relatively milder winter. But we're starting to see a modest uptick in delinquencies across credit cards and auto loans. Again, all signs that the consumer and the broader economy are coming under a bit of pressure, and the banking stresses only add to that pressure. And so, again, all this supports a more defensive, high quality, maybe stepping back into a little bit of duration within portfolios. And hopefully the Fed has the resolve to stay a little bit more cautious and calm here as the broader economy comes under some pressure.
We shall see, right? Jordan, it's great to see you. Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Thank you. Coming up, Coinbase shares getting a boost this morning, up almost 10%. We're going to talk about their earnings, and we'll have the opening bell next. Let's talk about some movers as we head to the opening bell. We're watching shares of Coinbase jumping almost 10% this morning after the crypto trading platform reported a big beat on earnings. It attributed that in part to its cost-cutting implementation. Of course, it has cut jobs this year, has cut some other costs in what has been a challenged not just trading environment for crypto, but also, of course, regulatory environment. The company back in March receiving a letter from the SEC about, operations because the SEC has been scrutinizing crypto trading more broadly. So this was sort of welcome for investors in this company.
Yeah, supreme year of efficiency vibes that we've heard from Coinbase for an extended period of time here. But you think about what they also had to say on the earnings call about bank failures and kind of marrying the two together, or at least juxtaposing what's taken place within the crypto landscape when you saw mid-March crypto largely just spike after some of the bank failures started to come forward, SVP, Silvergate, and so forth. As you saw that take place, you also saw this movement within Bitcoin and a rise that really has kind of sustained itself, at least kept it around this 27,000, 28,000 level, just shy of 29,000 as you're seeing there on the screen. And they touched on that in the call, touching briefly on bank failures in Q1. They maintained operational and risk excellence, they said, throughout the banking turbulence, saying that they also experienced no loss of corporate or customer funds and largely maintained business as usual operations, which was a gleeful way to say that, hey, the crypto landscape is an option for those of you that are not confident in banks. And so I looked at that as them kind of, being somewhat glib and trying to capture that opportunity.
Yeah, I would argue that that's,
It's exactly what that was.
Yeah, it was
Yeah.
The other thing to keep in mind for Coinbase, and this happened yesterday morning, a U.S. court said that the Securities and Exchange Commission now has to respond within 10 days to Coinbase asking for more clarification on securities law and how it applies to the company. So that, I guess that clock started ticking yesterday. Okay. And then after that, Coinbase has something like 7 days to reply. So that's something that investors in the company and crypto investors more broadly are closely watching. There's a lot of chatter around that. The stock fell yesterday, though, I believe, before that, the increase that we're seeing today.
Well, I mean, it's been an industry that's been looking for any type of regulation it can get, especially in the face of some of its largest kind of band-aids that it's needed to put over sentiment. You think back to SBF and what took place with FTX, and then even further back, you can look back to some of the algorithmic stablecoins that collapsed last year. And so there's been a major hit to confidence in crypto as a whole. So now, as the industry is looking for the regulators to not just add more validity, but add more opportunity for utilization of these coins, that's really what the growth and adoption still is going to hinge largely on. Where can you spend a lot of the crypto that you're holding in your wallet?
Right.
Besides it just being held as this digital gold is. Right.
Speculatory, is that a word?
Speculative, yeah.
Speculative, thank you.
Something like
Asset. Yeah, exactly. And by the way, the stock went up a little bit yesterday. It was down the day before. So misread the numbers there. Of course, we're coming up on the opening bell on Wall Street. We have the jobs report for investors to contend with today. We have seen an increase in bond yields on the back of that, as we saw that stronger than estimated growth at 253,000, unemployment rate at 3.4%, as well as wage growth of 4.4%. So slightly, ever so slightly bringing up expectations that the Fed could potentially move again, or is not going to maybe pivot or cut rates as soon as some investors had anticipated. All of that, we have been seeing strength in the futures here this morning. And let's get a check on the markets now at the opening bell, sponsored by Flex Shares. As things open up, we are seeing a gain in the market. So it's intriguing to me here that even with the increase in rates that we are seeing this morning, bond yields that we're seeing this morning, that does not seem to be putting much of a damper on what we're seeing for stocks here. Perhaps because what is the base case for markets now? Is it that the Fed is going to cut by the end of the year? I don't know. If it's not, if it's just that the Fed's going to be pausing for the rest of the year, then this doesn't seem to maybe necessarily change that. Even the Nasdaq up about 0.9%, the S&P up about the same amount, the Dow trading higher as well. So interesting that we are seeing that strength here, Brad, as we got to reset that Wi-Fi interactive.
Yes, we are. Yes,
okay, so that's happening here. So let's talk about our next mover, and then we'll circle on back to that. We're watching shares of Block this morning, the artist formerly known as Square. The company is seeing a boost in revenue for the quarter driven by its popular payment platform Cash App, despite battling a short seller report from Hindenburg Research. Man, Hindenburg's been busy lately, hasn't it? Block shares are not moving, though, this morning. We're not seeing much movement at all. They were up more in pre-market trading, though. Interesting. EBITDA topping estimates, so that's something that was positive for the company. Net revenue up 26%. And beating estimates as well. And I'm looking at the different sectors here. Subscription and services revenue up 43%. Hardware revenue up 1.2%. That missed estimates. Bitcoin revenue up 25%, beating estimates, and Cash App, which I mentioned, up 33%, beating estimates as well.
Yeah, and really pointing to Cash App Card as well, saying that they continued to expand some of the engagement there. 20 million monthly Cash App Card actives. That's up 34% year over year. That Cash App Card was pulled into question by Hindenburg Research as well, as they were able to sign up for a Cash App card and ultimately receive one with the name of somebody else on it. So that was an interesting part of the thread that they had put forward in their own research and kind of casting a ton of cold water, putting Block through the ice bucket challenge, essentially. But at the end of the day, I think it's still going to come back to where this company is able to maintain an operating income gain here. They're still looking at losses here. It was $6 million, which is kind of the lowest that I believe we've seen in a good deal of time for Square or for Block. $6 million in this most recent quarter. But the adjusted operating income, that came in at about $51 million there. So that some bright spot.
Yeah, it's interesting that it's not moving more. I've been trying to sort of piece out what the disappointment was. I do see a number of price target decreases here this morning in the wake of that. So I'm going to have to do a little more digging to get to the bottom of it.
Well, let's take a look at Carvana in the meantime here. Carvana shares are driving higher this morning as it tells investors it expects to reach positive adjusted earnings next quarter. Shares of the used car company are down over 80% over the past 52 weeks. However, if you took a look at the year to date, the bounce back that we've seen, okay, this is the past year, down by about 77%. But year to date, we've been tracking Carvana as well, because last year they took an L, but this year they bounced back, maybe? We'll see.
I wish that there had been a camera on me while I just looked up short interest in this company, because I did sort of a double take. 51% of float.
Jeez.
Which is extraordinarily high.
Yeah.
This has got to be a short squeeze that's going on here today, at least exacerbated. You know, like, this company still has issues, right? It still has a lot of debt here. Cash and debt positions at the company. Cash balance $488 million as of March 31st. Total debt and leases up to $8.7 billion. That's where they stood as of March 31st. This is a company that is not necessarily out of the woods in terms of its debt positioning, these comments notwithstanding. And so, like, this is one of those that we've seen in recent days, put it in the category maybe of a Bed Bath & Beyond. Not that I'm saying that this company is going to go under, but what I'm saying is that you have maybe a meme effect where people seize on what seems like a, marginally positive headline, and then you see just that short squeeze really help the stock take off. Yeah,
that has been the parameters that we can continue to look back to, or at least draw a thread through some of the meme stocks that had taken off or gone to the moon at some point and ultimately came back. But when you think about, for Carvana, the story that they're going to have to tell or sell to investors as well, this was a good first quarter for them. In fact, it was their best first quarter in company history. Retail units sold 79,240 there, and revenue of $2.606 billion. And particularly as I think back to some of the car economy, if you will, the car market, I should say, rather, and what we've heard from the retailers of cars and vehicles to those who are in mobility, like a Lyft that we were listening to, and their earnings, and then even a Ford, who we spoke with their CFO earlier this week. There's kind of this differentiation that all of them are trying to put forward at this point in time in order to best position the company for where on the economic front consumers are either pushing back on buying a vehicle by taking more trips, as we heard with Uber, or where they're even in those trips looking for the prices of those trips to come down, while at the same time waiting for the prices of vehicles, for used vehicles that in some cases are costing as much as new vehicles to still come down as well there. So, all that kind of encapsulated, that's, I guess, where I'm going to spend my weekend, is just going back and listening to what all of the different car or mobility companies are saying right now about the economy.
I mean, it's interesting what analysts are saying about Carvana in particular, that Piper Sandler's Alexander Potter said it's coming back from the brink. And there's some other analyst chatter here that things are getting better. Ron Josie over at Citi saying that the company has significantly improved unit profitability by right-sizing its inventory. So, I shouldn't poo-poo the positive reaction too much. It's just the magnitude of it obviously is, got to be short squeeze, at least in some capacity, short covering.
Yeah, no poo on that parade, just balls and strikes. That's what we're calling here. Guys, coming up, how do we keep a healthy labor market in a rising rate environment? We're going to discuss that next.
Well, we got another beat on another jobs day. Once again, I believe it is the 13th straight month that we have seen jobs numbers come in ahead of estimated, although we should mention we did see a lower revision for the prior month. 253,000 jobs added to the U.S. economy, the employment rate falling to 3.4%, and average hourly wages continue to rise. Let's talk more about the sort of policy environment here that maybe led to this and how we let it continue. Matthew Darling is joining us, Senior Employment Policy Analyst at the Washington, D.C.-based think tank Niskanen Center. Matthew, thank you for being here. So I guess, first of all, how would you characterize this current labor market, given, now we have a few months of data for this year under our belts? How are you thinking about it?
Yeah, I mean, this is one of the best labor markets we've seen in the United States for decades, right? 3.4% unemployment, like you mentioned. The number that I watch the closest is the prime age employment rate, the number of people who are between 25 and 54 who are working. We just hit 80.8% on that. That's a 20-year high. So, basically my entire life, this is the best we've ever seen. Even so, while we're doing really well compared to the U.S. historically, I do want to always mention that, when you go and compare it to other countries, sometimes they have a lot tighter labor market. So Canada, our neighbor to the north, of course, they have about the same level of prime age employment. It's at 85% for them. So it is something where we're in this wonderful environment. We're seeing, just so many effects that are great from having a tight labor market. Some of the things that I was really excited to see today was African American employment dropped to 4.7%. That's a record low, and so that's just been tremendous.
Yeah, no, that is a significant figure, especially considering that that is a figure that had run almost double the national average for a long time, actually. So good to see that gap coming a little closer together. When we think about wages as well, naturally, we all want great wages, but at the same time, you kind of put that up against what the Fed is doing, trying to combat inflation. So if you are in the employment environment and in the labor force, and you're looking at these wage numbers saying, hey, that's great for us, the employees, but at the end of the day, how much I'm spending as well is going to be impacted as the Fed is kind of going on their own route too. How do you kind of compare and contrast the two and what really matters within that figure?
Yeah. So, one thing I'll say is that, and I think this gets a little confused sometimes, is when Jay Powell talks, he's very clear that he does not think that we're seeing, a wage price spiral or anything like that, inflation is quite high. Wages are growth has been high, but he doesn't think that wage is the primary thing causing it. And I think that can get a little bit confused sometimes, that, what you're basically seeing is that, we're in an environment with a lot of high demand, a lot coming out of the fiscal supports and the monetary supports that we were doing during COVID. And that's led to, both high wages and high inflation. And so I think, we want to be attentive to wage growth as something that gives us information about, the potential of inflation. But it's also, something that we don't want to be looking to quash. And, while it's been very high, it's been leveling out a bit the last few reports. And so I think, we're getting closer to something where we say, okay, we're seeing, 4% wage growth, which is, consistent with the Federal Reserve's, long run goal of inflation being, around 2%. So, it's something that I don't think that, when we see wages going up, I think we should always think of that as a good news. But while sort of keeping an eye, how much is that predicting what's happening with CPI, what's happening with CPE?
And Matt, I want to look ahead from here too, because the Fed has warned us that unemployment is probably going to go higher because of their rate increase cycle. And so as we looked to the second half of the year, how can, from a policy perspective, perhaps we think about mitigating some of the effects of what is going to be a tightening job market?
Yeah, I mean, the first thing is always being, the Federal Reserve, as you said, they're anticipating increased unemployment. And I think we also want them to sort of make sure that they're aware of the trade-offs for their own decisions, that, we do really, really want to keep this, tight labor market with all the positive effects that has. That said, the Federal Reserve, they've got a dual mandate. They do want to work on inflation. And while inflation's been moderating, it's still quite high, both if you look at it over year, but also, even month by month, we're still on average seeing a little bit, something that's consistent with 4% inflation, 5% inflation. So, what I think about in those terms is, what can we do, if we do see spikes in unemployment? Again, we haven't seen these so far. What can we do to make sure that people are, able to find new jobs, even in the contractionary environment? One thing that I think about with this a lot is how much the United States spends on what's called active labor market programs, programs that actually go and help unemployed people go and get jobs. If you receive unemployment insurance, you're going to an American Job Center. We really just underfund that, both relative to where the United States used to be a few decades ago, but also compared to comparison countries. So the amount of money we used to spend on getting people into new jobs, that was about 0.25% of GDP in the 1980s, and it's down to 0.1 right now. And so it is something where we used to be able to reassign people to jobs and help them find new jobs in a way that we just don't have the capacity right now. And because we've just seen such a decline in funding for that. And let me add, that's something that is both important, like we talked about in a period of high unemployment, like we might be facing in the near future. But it's also something that I think is still important, even in the case we're in right now, where we have low unemployment and high employment. Because what we do really want to see, even in a tight labor market, is people being able to move from one sector of the job market to another. One thing that we are sort of seeing a little bit right now is some weakness in some sectors, right? So you're seeing a little bit of weakness in tech. You're seeing a little bit of weakness in journalism. And trying to figure out, okay, how do we get people who are maybe in sectors that are going to really struggle in a high interest rate environment and get them into the places that are still expanding, right? So you look at construction, you look at manufacturing. Those are places that, for the first time in a long time are actually fairly exciting places to be, places that you're seeing big job gains, even though we're in the high interest rate environment. And trying to get, how do we help people who maybe are struggling? There's always going to be unemployed people, even when there's 3.4% unemployment, that's still a big chunk of people. But how do we get those people into the jobs that are going to be growing, both in the short term and in the long term?
And just quickly, while I got you, Matt, I have to ask you about AI, because we had those comments in particular from the IBM CEO this week where he talked about over the next 5 years, we could well see quite a big chunk of IBM workers replaced by various AI functions. How do you look at that from a policy perspective?
Yeah. I mean, I would say, the thing to always look at with AI is how much are jobs being replaced and how much is tasks being replaced. You're right. So I'm a knowledge worker. I'm the kind of person who, goes out and writes summaries of what's going on in the world. And ChatGPT is pretty good at that. But what ends up happening is it does a lot of helping me write first drafts, helping me doing editing. But still, what I'm hoping is, that I have to be lucky on this, is that it's mostly replacing tasks. And I'm actually going to be more productive in the future. I think that, we should be concerned about AI in the same way that we are with other technologies, in the same way that, as industrial productivity increased for manufacturing, we saw a lot of people, factories close down and then people struggling to find new jobs. I don't think that the situation that I think people are really worried about, where, we're going to see, permanently high unemployment rates because of AI, I don't think that's particularly likely. I think that, there's going to be a lot more complementing human abilities, complementing human ingenuity than we are going to be substituting it for it. But I do think, like I said before, like thinking about, okay, we are probably going to see more than average labor market churn over the next, 5-10 years. And so that does mean, like I was saying earlier, it doesn't mean necessarily unemployment rates go up, but it does mean that, we want to think about how do we respond to that? How do we take people whose jobs really, are possibly going away? I think one good example of this might be people who work in like translation, which, AI is tremendously good at. And making sure that, those people have the ability to retrain, get new skills, and get back into the job market. But then at the same time, making sure that, we don't use AI as an excuse to sort of do bad macroeconomic policy. A lot of people were really concerned about AI, automated driving and stuff like that, 2014, 2015. And, when we look at it in retrospect, we can say, that wasn't about AI. It wasn't that jobs were getting automated away. It's just that we were in a monetary fiscal environment where we were just not providing people with the economic support to really get us out of, a tremendously large recession. And what we really saw in 2020 in COVID is that, if you do the effective monetary policy, if you do the fiscal policy, it really does get you back into a tight labor market really, really fast. You could argue that it's too fast, and that's why we saw inflation go up. But I do think that we did really see that, when you combine giving people who lose their job support and overall fiscal and monetary support just for macroeconomic economy, we do continue to see a robust labor market.
Matt, thank you so much. Really great stuff. Matthew Darling, Niskanen Center, Senior Employment Policy Analyst. Have a great day.
You too.
Thanks. Coming up, a wider loss than expected for Warner Brothers Discovery. Ali Canal is going to give us a pulse check from the earnings call next.
Warner Brothers Discovery reporting a big quarterly loss as the company prepares for the launch of its new Max offering in May. And this is going to be in a competitive market for streaming, we should add. Yahoo Finance's Ali Canal joins us now, fresh off the call. Ali, what'd you hear?
Yes, well, if we take a look at the share price right now, they're losing a bit of steam as investors digest that earning miss, that wider than expected loss that you just talked about, as well as those comments on the call, which just wrapped. Now, those stock declines, they largely seem to be tied with that earnings miss, that overall loss of $1.07 billion in the quarter. But on the call, management was pretty positive, especially when it came to the future of streaming. That was a big highlight on this call earlier this morning. They said they are significantly outpacing their profitability guidance for streaming, especially ahead of that Max launch on May 23rd, which management said should continue to drive growth. Now, along with streaming, the company said it's going to be very focused on making prudent financial decisions, making sure they are monetizing their content to the fullest extent. CEO David Zaslav, he emphasized it's all about quality over quantity for both their streaming content along with their film franchises. They want to continue to improve free cash cash flow, which continued to be a pretty serious headwind this quarter, negative $930 million for the quarter. One way to do that, though, is to make sure that your financial decisions are sound, that you're not overspending. So that is a big goal. And then if we take a look at the advertising market, this has been a major headwind for a lot of these legacy media companies. The phrase being thrown around is cautiously optimistic. Here's a bit more of what CEO David Zaslav had to say when it comes to the future of the ad market.
While our results for Q1 continue to reflect the current soft ad market, we are optimistic for a gradual improvement and an eventual upturn in the second half of the year.
Now, the upfronts are right around the corner, which should provide a bit more clarity on the state of the ad market. Zaslav saying there's a lot of opportunity for Max. There's a lot of opportunity with CNN, with the political cycle right around the corner. They said for the upfronts, they're going to be heavily targeting potential advertisers for town halls, various primaries, also the fact that they have sports and their ad-supported offerings for streaming. Those are big focuses of the market right now. But as we've seen over and over again with a lot of these companies, Paramount just reporting yesterday, the ad market, it's not doing well. You know, it fell 14% in the quarter, excluding foreign exchange for their network advertising revenue. So we'll see if there's any improvements, especially with the upfronts coming up very shortly. But that is a major headwind.
I mean, so overall, if you had to, you know, grade the call, I guess, it seems like it's not a great idea. It's not a great effect on the stock, to your point.
Not a great effect on the stock, but I'm going to buck what investors are thinking right now, because it seems like in general, there are more upsides moving forward than challenges. They've seemed to have reached a point where they battled a lot of those restructuring headwinds. So I'm going to go a bit controversial here with my vibe check and call it overall good. And I have read, you know, some quick analyst commentary who say that overall, the fact that they have improved their streaming division so much, the fact that they have been, you know, coming through with these cost-cutting initiatives, that is a positive moving forward. So I think given the fact that we seem to be having more momentum in front of us, that is what's driving my good vibe check call.
All right.
Bit controversial though with the share price right now.
Hey,
We'll see.
hey, you know what? You woke up today, you chose violence. You did that. That's okay.
It's a Friday too. I mean, I'm already in a good mood.
Well, we're going to continue to track shares. They're off of their session lows, so that is a good thing.
Yes, they're recovering after that call a little bit.
Absolutely. All right. Perhaps the vibe is improving more broadly as well. Yahoo Finance's own Ali Canal joining us here this morning with all things WBD. Coming up, another big week for regional banks, and there could be more trouble ahead. We'll discuss that next. Regional banks catching a breather today. PacWest is leading the rebound in regional bank stocks today. After a brutal week, it all began on Wednesday for PacWest following news that the Los Angeles-based bank was exploring strategic options, including a potential sale. And there could be more trouble ahead for the banks. The American Bankers Association asking the SEC to take action against what it calls market manipulation and abusive short selling practices. In a letter, the trade group representing the U.S. banks saying this: since the two bank failures in March, some of our members have experienced significant short sales of their publicly traded equity securities that do not appear to reflect the issuer's financial status or general industry conditions. Taking a look at shares of regional banks here today. Well, just a little bit of reprieve here. Coming up, has the gig economy peaked? We're going to speak with an economist from Bank of America coming up next. Welcome back to Yahoo Finance Live this morning, everyone. Brad Smith here with Julie Hyman. Happy top of the 10 a.m. hour to you on this Friday. We're about 34 minutes into the start of trade on the day. Well, after a pandemic jump, gig workers, they are on the decline. A new study from Bank of America showed that only 2.7% of its customers received gig-type income in February, proving gig work may have peaked. Anna Zhou, who is the Bank of America Institute economist, joins us now. Okay, so on headline, what are we seeing within the gig economy right now as it relates to the broader state of employment?
Sure. First of all, thanks so much for having me today. So the gig economy over the pandemic, we've heard anecdotally that there was a big surge. But the problem is there's actually no good public data that can actually capture it. So we at the Bank of America Institute, we utilize our data sets based on 67 million consumer and small business accounts to uncover these type of trends. And what we saw is, yes, there was was around a 50% increase in the number of customers receiving gig type of income over the pandemic. But what's interesting is there was a 20% decline in terms of customers doing gig jobs over the last 12 months. So is the peak of gig economy behind us? We think there are two factors at play. The first one is consumer demand for such services might not be as high as they were a year ago. So think about me as an example. Like, I probably don't want to order takeout on a Friday night anymore. I want to go to the restaurant and actually enjoy that, right? And that's on top of overall consumer spending also moderating. So they're just generally spending less money, right? And the second factor relates to the labor market. We found that some workers might be rotating back to more traditional labor market because the wage inflation there is very strong. So think about, workers in leisure hospitality, in retail. They're seeing very impressive wage growth, and that might be attracting some workers to, go away from the gig job but back to more traditional.
That's really interesting. Is the wage growth in more traditional sectors better than what we're seeing on the gig side?
Yeah, I think that's a great point. So when we look at customers who do gig works, we found they tend to work in restaurants or retail stores. So think about a clothing store at a mall. And these are the sectors that saw the strongest wage growth over the pandemic, right? So I think this morning's report for leisure hospitality, it was still up around 6% year-over-year wage growth. On the flip side, when we look at gig workers, how much they're receiving in their bank accounts from gig jobs, that number has been pretty flat since 2019. So that contrast really is promoting the shift back to traditional jobs.
We used to have this conversation about how many gig workers were actually keeping an app open for multiple companies. Are we still seeing that overlap of the base that is still employed in a gig capacity where you're a driver for Uber, but you're also a driver for Lyft, or you might be doing deliveries for DoorDash? Is there still that Venn diagram overlap that we're seeing?
Yeah, sure. I think that's a great point. Our data can't really differentiate that details, but I think there's definitely a possibility that people are doing multiple jobs. But as I mentioned, they're trying to weigh which option is better for them, right? And I think at the moment, what we're seeing is they think maybe working in a clothing store, at a mall, in a restaurant might be better than them driving share rides, yeah.
You mentioned a couple of times how difficult it is to get this data. I mean, it's something we've grappled with on the show before when we talk to economists.
Yeah.
It's really difficult to measure these folks. So talk us through the data. How are you sort of extrapolating this and figuring it out?
Totally. So what we do is we look at our customer's account and look at that money inflow into their account. And we're able to differentiate which number are from traditional paychecks, which are from these gig type of incomes. So we kind of use this as a proxy for gig workers based on whether they receive money, say, from delivering a restaurant takeout.
Is there a time span that you find that they're averaging out at, essentially? Because if I have a conversation with an Uber driver, sometimes the first question I ask is, hey, how long have you been driving for Uber? Just as we're having the conversation for that ride, I often discover a lot about them and the reasons why they started driving and what their means to an end is. So do you kind of find out through this data what the average time span that someone is saying, you know what, I'm just doing this so that I can make ends meet for a little bit until that next thing comes around?
Totally. I think gig economy overall is a fairly new phenomenon, right? And I think that's part of the reason why, say, jobs report doesn't capture it as well, because when the survey was designed, gig economy wasn't around, right? So for majority of people, I would say they have been doing this not for so long. And to your point, when we look at the gig income, that they're fairly flat over the years, one theory is that maybe they're only working to a certain amount to supplement whatever they need, right? And that's why they're, say, like $1,000 per month, that's why they're keeping it flat over the years. Yeah.
Is there any way of trying to, you said this may have peaked, but we don't know, right?
Yeah.
Because you could envision a situation where demand on the part of gig workers and gig work increases in a tough economic environment, but that demand on the employer side does not increase, right?
Yeah.
So what are you guys expecting?
Totally. So there has been some research that suggests there might be a correlation with gig work and the traditional labor market, in the sense that if someone couldn't find a full-time job, they might just pick up a gig work, right? Right now, we're seeing the exact opposite, where it's very easy to find a full-time job with good wage growth. That's why we're seeing the decline in gig work. But going forward, it really depends on two factors, how the dynamic plays out. One is, are consumers still spending for these type of things? Then it will determine whether there's demand for these services, right? On the flip side, if wage growth remained really strong, as we saw in this morning's report, headline numbers was really strong, average hour earnings was strong, maybe that will keep these workers in the traditional markets for longer. So which factor plays out, will let the data speak in coming months.
Yeah, makes sense. Anna, thanks so much. Really interesting data, and hope we can keep in touch on the further work that you guys are doing. Anna Zhou is Bank of America Institute economist. Thank you.
Thank you.
Let's get a look at a trending ticker that we're watching today. It's Johnson & Johnson's consumer healthcare spinoff, Kenvue, falling slightly today. Of course, went up over 20%. So it skyrocketed yesterday in its public debut, making it the largest U.S. IPO in over a year. Kenvue marks the biggest restructuring in Johnson & Johnson's history. Well, coming up, calling all moviegoers. AMC shares are slipping on the back of its earnings report. We'll have the details next. Let's do a quick check of the market sponsored by Flex Shares right now. All three major averages, taking quite a leg higher here. Earlier we saw them up less than 1%, but now we are seeing some strengthening here in these markets. Quite interesting. Right now the Dow up 1.4%, the S&P up 1.4% as well. The Nasdaq is leading gains, which again is interesting given that we got that better than estimated jobs report and yields have been going higher. I'm just checking out the sectors. We've got energy, which has been battered in recent days, along with oil prices coming back today. XLE up 3.2%. The XLF, that tracks the financials, up 2.1%. The XLK higher by 2%. And Apple, not the only big NASDAQ mover that is stronger today. We also have the likes of NVIDIA rising 2.2%. Tesla up 3.4%. Some weakness in Meta and Alphabet, but it looks like it's more than offset by other areas of tech. Well, the box office is back, but is it enough to give AMC the happy ending it wants? The theater chain reporting earnings with a slate of strong releases, driving audiences back to theaters and driving better than expected sales and a lower than expected loss. I think actually sales might have missed estimates, but the theater chain has not quite reached its expected finale just yet. It continues to burn cash and faces down lawsuits. Here with the viewing angle on the theater and entertainment industry is Geeta Raghunathan, Bloomberg Intelligence Senior Media Analyst. Geeta, it's good to see you here. What do you make of these AMC numbers, and in particular, the sort of divergence on the top and bottom line beat and miss there?
Yeah, thanks so much, Julie, for having me. So I think overall, the sentiment in the box office, the sentiment generally for the theaters is pretty positive. We've seen some really, really good numbers coming out of, the movies that have recently released. Super Mario is, of course, the biggest example. Over $1 billion in global box office, over $500 million at the domestic box office. So it's absolutely stunning. And that has really led to a lot of optimism generally in the box office outlook for this year. So remember, when we kind of started out, we were thinking about $8 to $8.5 billion for domestic box office. That's gone up now to close to almost $9 to $9.5 billion. So I think the top line is definitely looking a lot stronger. Remember, for AMC, the good thing for them is they over-index to the premium large format. So they have the largest number of IMAX screens. They have, all these recliner seats, all the bells and whistles in their theaters. So they are able to aggressively charge both on, ticket prices as well as concessions. But again, the big problem for AMC, as well as a lot of the other theaters, has been their huge levels of debt. And so that's kind of where we're seeing a lot of the, ongoing, doubts, ongoing skepticism about whether these movies can still, sustainably generate a good bottom line, good profitability numbers. So again, that still has to play out. But I think overall, we're definitely seeing a much more stronger, much more positive tone.
Does that mean that this company is going to need to raise capital again, either through an at-the-market equity offering that we've seen them do that I think netted them over two different tranches, about $1 billion essentially? So is that something that they might have to explore again from your perspective?
I think absolutely they will. So they have about $5 billion in debt, and it's a substantial amount. So that almost results in about $400 million in annual interest expenses. So I think for a long-term, a sustainable business profile, they obviously do need to raise capital at some point. I think they have sufficient liquidity right now, but again, they will need to raise capital, and they've been taking a lot of measures towards that, right? So the whole creation of the APEs or the preferred equity units, as well as now all of the different motions to kind of convert that or combine them with the shares is kind of their way is finally paving the way for them to raise more capital. Of course, there are still a few legal hurdles that they have to overcome. I think there's a June hearing that is still pending, but eventually the idea is that they should be able to raise substantial amount of capital and kind of dig themselves out of this debt hole.
At the same time, Geeta, any capital they raise is going to be at a higher rate, right? Because we have seen these rates go higher. I know that you don't give necessarily stock recommendations, but is all of this going to continue to be an overhang for the stock, or once they sort of succeed in maybe raising that capital, will that maybe unlock some value for shareholders?
I think that will definitely be a major catalyst, Julie, because, once they're able to raise that capital and you have this box office outlook kind of strengthening. So we've already seen, this tremendous upsurge in terms of sentiment, because there was always this big fear about has streaming kind of killed the movie business, but we're not necessarily seeing signs of that, at least this year, because studios are making huge commitments to the theaters, and we're seeing people kind of come out in droves. And as you just see, actually today is kind of the start of the summer season with the Guardians of the Galaxy release, and we have just a fantastic slate. So we're seeing 35% higher number of movies released this year in theaters, and we're going to see that slate only strengthen further into 2024 and 2025. So I think definitely, that optimism and that bullishness combined with their capital raise definitely does point to a much more encouraging outlook.
Geeta, AMC Chief Financial Officer Sean Goodman had this to say on their call about their plan to keep the money flowing in. Just want to play this quick clip and get your reaction on the other side.
Our loyalty programs and the AMC app, 2, our food and beverage innovations, 3, sight and sound experiences through advanced laser projection technology and premium offerings, and 4, diversification initiatives such as the successful launch
of the AMC ready-to-eat and microwave popcorn and the AMC branded credit card.
Now, as our team knows, I'm not a fan of popcorn, so that's not going to move the dial for me. But perhaps if I was a rewards member and I was trying to kind of stave off my discretionary spending from being hit by an expensive movie theater experience, then I would lean further into that if I was going through an impending recession. So based on what we've seen during past recessions and consumer activity and engagement with movie theaters, how is AMC positioned going into an environment that many companies have been spelling out over the course of this earnings season?
So entertainment, movie entertainment or movie going actually tends to be one of the cheaper forms of entertainment. And so it has held up very, very well, even during recessionary periods. We've seen this time and time again. People still love to escape. They still love to go to the movies. And it is still pretty affordable, even in kind of this macro downturn. So hopefully, movie going should still hold up. At the end of the day, you bring up a really important point with the loyalty programs. They do want to get people back in seats. Remember, at the end of the day, they want to be able to sell them, popcorn and soda, because that's really where they make all their money. That's, it's 85% margins versus less than 50% margins on a movie ticket per se. So, at the end of the day, if they can get more people into theaters, theaters, that does help their overall profitability profile, very, very, very significantly.
Geeta Ranganathan, who is the Bloomberg Intelligence Senior Media Analyst. Geeta, thank you so much for taking the time here today. We appreciate it. And coming up, everyone, the state of Scrubs. FIG CEO joins us next to talk earnings. We'll be right back. It's fashionable. FIGS released better than expected first quarter results, boasting a rise in both revenue and customer base. But the company warned of a difficult macro environment in their 2023 outlook. Joining us now, we've got Trina Spear, who is the FIGS CEO. Trina, great to speak with you and great to get some of the time with you after these results have dropped here. First, as you think about what we were just mentioning in the macro, that a lot of companies are trying to spell out to investors how it could impact their businesses. What most notably have you seen within FIGS business where that's already started to kind of loom over some of the numbers?
Yeah, sure. And thank you. Good to see you, Brad, and thank you for having me. I think what we're hearing and what economists are saying is that the macros can continue to be challenged with inflation, consumers moving through stimulus checks, they're in savings mode. But I think what we're seeing with our healthcare professionals is a bit of a shift where they are kind of re-energized coming out of COVID. They're excited to get back to work, hiring, wages, staffing levels are ticking up across hospitals. And so that's a good thing to see, but they are definitely still being impacted by inflation. And, I think those two things are kind of offsetting each other right now.
And it looks like that showed itself in your average order volume, right, during the quarter. And so, Trina, what can you tell us about that kind of flow, what you're seeing, and what you expect now for the rest of the year?
Yeah, I think, if healthcare professionals more than ever are joining this profession every single day, and they need their uniforms, right, to go to work and do their jobs well. They're also, what we're seeing is, they're adding other elements of our layering system to that uniform. And so we're seeing our non-scrubs portion of our business around 20% of revenue, which is great to see. So, as we move through this year, we hope to see our customers kind of re-engaging with us throughout the year. We have really incredible replenishment rates. Our healthcare professionals come back to us over and over and over again to replenish their scrubs. And as you've seen, healthcare is really resilient. So, we are encouraged by what we're seeing, and we look forward to this year, and more importantly, kind of coming out of this macro environment to the future.
Are there other categories that, even as you look across the relationships that you've already had with so many customers and looking to even deepen that relationship beyond the scrubs that they may have bought, where accessories, where, I don't know, maybe it's too much to say footwear, where those other kind of branches for FIGS business could be? I haven't heard about a FIGS belt bag yet. Maybe that could come now next.
It's coming. No, I think, you're absolutely right? Our goal is to outfit healthcare professionals to work, at work, from work, on shift, off shift, head to toe. As it relates to footwear, we have a great partnership with New Balance, and we continue to launch, every single week we're launching new styles, new colors across categories, and it's a huge growth driver. In addition to that, I think you all know we have essentially one channel, right? We're an e-commerce business. So the other growth levers in our business are, as it relates to in our international business, as it relates to our teams business, where we're partnering with institutions to outfit their teams. And, we have no stores. We're launching our first, permanent store later this year, and we have a full retail rollout to come.
I'm looking at your site, man, it's sale, promotion. I know you talked a little bit about this on the call, what the cadence is going to continue to be like here. Not only is everything, it looks like, marked down, but then is there a 20% off on top of that, if I'm reading it right? And yet you guys still managed to expand margins more than expected. So how's that dynamic work?
So you're looking at basically what we call our Super Bowl. This is Nurses Week. This is our time to celebrate all of our nurses and all the hard work and dedication that they have to society. And we're so just honored to be able to serve our nurses.
Yeah, there's a whole dance routine that they're doing here on your site.
We love dancing, we love music, and we love celebrating our awesome humans, which is what we call our healthcare professionals. So that's what you're seeing right now. It's a week event, although we look to celebrate them every single day of the year. And so we're really excited. It's a great week, and we're happy to serve.
I've been working on my TikTok dances if you guys ever need another choreographer at hand for these shoots. So just keep me in mind there. Lastly here, when you think about the total addressable market and the employment that you were talking about within the healthcare industry, we also kind of have continued to have these conversations, especially on Jobs Day here, about where there might be a replacement of certain roles due to artificial intelligence. Is that something that impacts the total addressable market within healthcare that you think about and that you have to kind of resize perhaps some of the total addressable market expectations as there is more of that technological development?
Yeah, I mean, healthcare professionals aren't going anywhere. Doctors and nurses globally are an important part of any functioning society. And if anything, healthcare jobs are the fastest growing job segment over the next 10 years. I think what AI will do will, alleviate some of the administrative burden that healthcare professionals are dealing with right now. And that's a great thing. And it will help them get back to helping their patients and curing diseases and saving lives and all the incredible things that healthcare workers do every day. So I think that's the dynamic that we'll see going forward. But they're everything to every part of any functioning society. And we're super excited that we're able to stand alongside them as they go out and do their work.
Trina, can I sneak back around to the margin question for just a second? Because we got excited about the dancing. But talk to me about that, about margins and whether we can expect to see that continued momentum for the rest of the year.
Yeah, I mean, I think from a margin perspective, you're continuing to see us balance growth and profitability. And you saw that once again in the quarter. And I think, our goal is to maintain around 70% gross margins, which you don't see in retail, right? And so we're really proud of that. From a bottom line perspective, we're incredibly profitable and we're going to be generating a lot of cash this year. And so I think, we're going to, at the same time, invest in the business. We have an incredible amount of growth ahead of us. We need to invest in our infrastructure, invest in our people to ensure that we'll continue to be an iconic brand over the long run. But we have an incredibly healthy balance sheet. We have no debt. We're able to invest. We're able to do all the right things so we can continue to execute on every level.
Trina, good to see you. Thanks for spending a little time with us this morning. Trina Spear is CEO of FIGS. Thank you.
Thanks so much. Thanks.
Coming up, we're going to cruise back to the Milken Conference for Brian Sozzi's conversation with the CEO of Carnival. That's next. After several years of battling the rocky waters of the COVID-19 pandemic, the cruise industry now finding itself burdened with debt. But with traveling restrictions fading into the horizon and bookings picking up as cruisers return, what's next for cruise lines? Yahoo Finance's executive editor Brian Stasi spoke with Carnival CEO Josh Weinstein at the Milken Institute Global Conference.
We're back. As of last month when we reported on our first quarter, we had record numbers, right? We just got through the wave period, which is the highest booking period in the industry. We literally had the most bookings in the history of our company in that 3-month period. And that was both our North American brands and our European brands, which took a little longer to get back into that flow. So frankly speaking, between that and our first quarter results, where we beat on every single line item, things are trajectorying in the right trajectory.
Where are the bookings in relation to pre-pandemic levels?
So our book position is basically, if you look back at the last 15 years, it's one of our highest we've ever been in. So by the time we looked at the rest of the year at the end of the quarter, we were already 70% booked for the rest of the year. So we are very well positioned for the continued momentum and continued improvement.
How does pricing look?
Pricing's been pretty good. What we saw since we've been through our restart is you got two aspects of the pricing. You got how much are people spending for tickets and how much are they spending on board. The onboard spending has been record levels, and we are talking about 20% higher than before the pandemic. And the good news is, over the last 5 quarters, while that's been maintaining at a nice steady pace, the ticket pricing is inching back up every single quarter. So the trajectory is really, again, I couldn't be prouder of the team and the things that we're doing.
I've heard a lot at this conference about an economic slowdown. I'm catching a different vibe from you. How do you square that?
It's actually, I don't think it's particularly Carnival Corporation. Travel and leisure has not slowed down. So, what we see is a consumer base that is demanding experience, demanding travel. I mean, we got to remember, people have been pent up. That demand has been latent, waiting. And yeah, it's true, it's been 1.5 years since the pandemic has run its course. But I'll tell you the truth, people had time. They had time to think about what are the things I really want to do, and they're expressing it now. And so between the future bookings and the real-time impact of onboard spending, we just see no slowdown.
Is there still that cohort that is afraid to get back on a ship?
There probably is. I mean, here's the thing about us and the thing about cruising. We're tiny, right? In the overall vacation market, we are, no matter how you want to cut it, less than 3%. There is a huge market of potential consumers out there in all of our main markets, the United States, the UK, Germany, Italy, Australia. What we need to do is amplify our voice and get more people who have never cruised before to consider us, and that's happening. Our level of first-time cruisers is almost back to where it was pre-pandemic, despite the concept that people might have been afraid. People understand value. They understand when their friends and family get off of a cruise and go home and rave about how amazing that experience was. It resonates with people, and they bring their friends and family next time.
Do you still hear that old saw that cruises are just for old people?
Yeah.
I'm guessing you don't believe in that.
I don't. As a father of 3 kids who are now 18, 16, and 13, I can tell you we've been cruising every year since our 18-year-old was 1, and that is so far from the truth. I mean, there is truly something for everyone. And if you've never been, I can understand the myths, but the fact is, in today's world, there's not one main dining room with a early seating or a late seating as your option. There's actually 15 restaurants. You book like you're on land. There's 15 bars. There's water slides and roller coasters and ice cream parlors and rock walls and ice rinks. I mean, you name it. The cruise industry is radically different than where it was in the past, and we've got the demand to show that it's working.
Any line of sight into Carnival going back to China?
I mean, the good thing about our assets is they're mobile. And so China has been shut down for international cruising for 3 years now. So we've done what we needed to do to, move our assets where the guests are going to be and where they're going to want to sail. If and when China opens up for international cruising, it will be fantastic for the industry, and we'll look at it. Because our ships are mobile, we can go back. As of yet, there's nothing on the horizon I've seen, but we're patient.
You've touched a lot of different areas inside of Carnival. One of the cool areas I think that you touched is the numbers. You know a lot of the numbers. You've been at the company for a long time. There's a lot of issue, or just a lot of focus on our platform by retail investors. They understand Carnival. They understand what you do. But there's been concerns about your debt levels. When are you going to bring them down? Yeah. And what is an acceptable level of debt?
Well, yeah, I am a former treasurer, and so getting back a fortress balance sheet is incredibly important to us. We peaked at $35 billion of debt. I was very, very happy to say on our last earnings call 2 very important things. Number 1, we have no intention of issuing any more equity. And number 2, we are starting to pay down the debt.
I just want no more stock, because I know that has been talked about. No issuance. No issuance.
Ultimately, it's always a board decision, but we have zero plans to do that. We've got the trajectory. We were generating cash. We are a cash generation business. And when you look at our CapEx profile over the next few years, it's our lowest ship order book in decades. When I first became treasurer in 2007, we had 24 ships on order. We now have 4 ships on order and a very small expedition ship. And that's it. And what that means is we take that cash and we pay down the debt, and we get back on the road to investment grade credit metrics, which is what we're shooting for.
How long do you think that would take?
Oh, it's years. It's not months. But we've got plans in place. We've got demand generation that's going to support that cash generation and expedite it.
And that was Yahoo Finance Executive Editor Brian Sozzi with Carnival CEO Josh Weinstein. And coming up, same Sozzi, different state. We're heading live to Omaha ahead of Berkshire's annual shareholder meeting. Yes, kisses for all. There is Brian Sozzi. We'll check in with him on the other side. Yeah, more kisses. All right, cool. We'll see you soon. Berkshire Hathaway's annual shareholder meeting begins tomorrow. Investors are descending in Omaha to seek market guidance from CEO Warren Buffett and Vice Chair Charlie Munger. In focus, Buffett's thoughts on the seemingly persistent banking turmoil. Shares of regional banks still sliding a week after First Republic's failure. Also, Apple, Berkshire's largest holding, outperformed in earnings. But how will tough macroeconomic conditions affect the rest of the year? Yahoo Finance Executive Editor Brian Sozzi is on the ground in Omaha, joining us with his thoughts now. Brian.
Hey, Brad and Julie, good to see you. Yes, the crowds, what you don't see here, the crowds are lining up to get inside of the CHI Health Center here. Crowds will be allowed in at noon to walk the floor here and see everything. A lot of the companies, a lot of the installations set up by Warren Buffett, Borsheim's, Kraft Heinz, mustard, ketchup, See's Candies, a lot of installations and exhibitions and celebrating all things Warren Buffett and Berkshire Hathaway. You can also see there's also a lot of crowds. There's a Hilton across the street here for over $1,000 plus a night at least, where a lot of those Berkshire Hathaway shareholders do in fact stay. A lot of crowds in there. You saw a lot of meetings. I think a lot of Berkshire shareholder analysts, or yet not analysts, the shareholders thinking about and talking about what they might hear from Warren Buffett. Very interesting to see. Briefly caught up with billionaire Mario Gabelli, longtime investor in Berkshire Hathaway, I believe going back to 1986. He has cleaned up in Berkshire, so good to see him on the ground doing his thing. But again, packed house here so far. You can see the crowds gathering in here a little bit more to get early access to all things Buffett. And it comes at a very interesting time, guys, as you've been covering all morning long. You had Paramount shares absolutely slaughtered yesterday on that dividend cut. Buffett went out there and bought Paramount in November 2022. I am very interested to hear what Warren Buffett comes out and says on Paramount. Does he sound out against that management team? Unclear to me. And of course, Apple. Apple's quarter is being well received by the market here in the early going here. $90 billion stock buyback, calling out strength in emerging markets. Very curious what the Oracle Omaha has to say on one of his newer and one of his largest holdings in Apple.
Yeah, really interesting. So many intriguing questions we could ask him. I'm curious about Occidental Petroleum also, right, which has been a big winner for him. You mentioned ketchup and mustard, Brian Sozzi. Tell us more.
Oh, you know I did that on purpose, Julie Hyman. That was a setup for the interview. I see, you know what? We've been working together for a long time, and you just know each other. But to that end, I caught up with Kraft Heinz CEO Miguel Patricio ahead of the Berkshire meeting to get a sense on his turnaround. And why is all this important? It is because Berkshire Hathaway still owns about 28% of Kraft Heinz, has 3 board members on that Kraft Heinz board, notably likely Buffett's successor and Greg Abel. So I talked to Patricio about the company's turnaround and if there is, in fact, a turnaround brewing.
4 years ago, we were a depressed company. And then when I was starting working on the strategy, came the pandemic. And I thought, Brian, that transforming the company through teams would be impossible, but it was not. And at that time, we were downgraded to junk or to high yield. We had a big debt. We were able to pay $10 billion of debt. And 2 years later, we were in investment grade again. And with that, we created momentum. And we start transforming the company in all parts of the company, from sales to finance, from marketing to supply. And this has been a journey. I mean, we are in a very different place today and very engaged and very energized and very optimistic about the future.
Well, you just came off your earnings, and I think your earnings, Miguel, really surprised a lot of people on Wall Street. And my question to you is this: do you think investors are missing a turnaround story at a storied brand like Kraft Heinz?
I mean, I think that we have to earn it, and reputation you build with time. It is not from a day to another. But the truth is that we've been beating estimation, beating the market for 12 or 13 quarters in a row. So, we've been proving that we know what we're doing. I mean, this quarter we grew 9.4% in net sales, 11.9% in EBITDA. We grew 13.3% in adjusted EPS. We grew margin. And parts of the business that we, like emerging markets and food service, that we told the market that would be representing 2/3 of our growth, really excelled expectations of the market. I mean, emerging markets, we grew by 23%, and And food service, we grew by 29%. So it was a very good, very good quarter.
One thing I think you've done really well with inside Kraft Heinz, Miguel, is driving more focus in the organization. Now, there's no secret that investment dollars were starved under prior management. You came in giving more of your top brands more investment, more room to grow. Where are you at with some of those power brands and reinventing them?
So this was one of the things that we did. I think that 4 years ago, we were apologetic about our brands, and we thought that the future would be smaller brands and, and very niche brands. And we were launching a lot of different brands in the market. We did just the opposite. We focused on our core. We have incredible brands. We have $6 billion brands, Heinz, Lunchables, Kraft, Kraft mac and cheese, Lunchables. It's just incredible brands. And what we did was reinvigorate these brands. First, we renovated the brands, packaging, formulation, communication, and also overseas. I mean, we put our investments in emerging markets and also in food service. And the strategy has been working. I mean, we've been better every quarter since 2019.
And now, what is next for two brands in particular? I'm very focused on the core mac and cheese business, and then a brand like Lunchables. What's next for those two brands?
Now, specifically on brands like mac and cheese and Lunchables, let me tell you Kraft mac and cheese. One of the things that we have very different from the rest of the market is that we play in stable products like ketchup, Heinz ketchup. We play in refrigerated products like singles or Philadelphia cream cheese. And we also play in frozen food. Like we are leaders in frozen potatoes like with Ore-Ida. There's no other company that plays in these three different states of temperature. And our brands have never really navigated through the three ones. And there's a big opportunity. So like Kraft mac and cheese, we are about to launch frozen Kraft mac and cheese.
Frozen?
Yeah, mac and cheese frozen is a market of close to $800 million. We never played there. And we never played because we were organized, the frozen team and the refrigerated team. And as a consequence, each one was playing a different part. We are today much more integrated as a company, working together in a much better place, which gives us chances to do what I just mentioned. It's obvious. We just had not done it yet. Lunchables. You recently saw us launching Lunchables now in schools. Food service is a huge market. Schools is an untapped market for us. And we, although our Lunchables business is based on kids, is $1.2 billion brand, but that moms give to kids to go, to school. But we never sold in schools. And to sell in schools, we had to adapt to make Lunchables more nutritious, and that's what we just did. So we are going to have a much bigger reach, a much bigger distribution of Lunchables. And I could talk to you about innovation that we are preparing for Lunchables as well, but that would take a while.
I'm sure it will. So what I'm hearing from you is a reinvention of some of these story brands, Miguel. I believe now you're on track to save $2.5 billion in cost by 2027. Lots of good things going on at the company. And as I think about, right now I'm in Omaha getting ready for Warren Buffett's annual meeting. Of course, he remains a very significant shareholder in your company. He has been critical of Kraft Heinz the past few years, but I'm hearing a turnaround story. What has your interaction been with Greg Abel, who might be the successor to Warren Buffett and who's on your board? What has he had to tell you of late?
Yeah, so Greg is one of our most important board members. Berkshire has about close to 28% of our company, of the shares of Kraft Heinz. They have 3 chairs in the board. And the good thing is that we get along very well. I mean, some of the values of Berkshire are exactly the same as some of our values. They are very simple people, very straightforward, no egos, as we are and as I like my people to be.
All right, there you have Kraft Heinz CEO Miguel Patricio, Julie Hyman talking about the innovative product coming up, and that is frozen mac and cheese. Having said all that, as you can see, and I didn't oversell this despite the overture by my producer off camera, Kevin. You can see the crowds coming in here. A lot of folks that we have started to talk to are from Brazil, China, England, lining up to get that real insider access to Warren Buffett tomorrow. But as for today, they're going to get in there around noon, walk around all things Warren Buffett Palooza. That is whether it's Borsheim's exhibitions or his See's Candies, Dairy Queen, Dilly Bars, you name it. That is everything they're lining up to see and just get a taste of all things Warren Buffett. Unfortunately, guys, no frozen mac and cheese from Kraft Heinz. Maybe there is, but I'm betting there won't be.
I hope that you microwave it before you eat it.
Just a little bit. Heat it up.
No comment, sounds like you got a weekend of healthy eating ahead of you, Saz. Enjoy it.
Just one Coke a day.
Thanks for having me.
You got it. Yahoo Finance's own Brian Sazi out there in Omaha, Nebraska. Let's do a quick check of the markets here, sponsored by Flex Shares, as we are nearly 90 minutes into the start of trade on the day. The Dow Jones Industrial Average holding on to gains quite healthily. It's up by about 1.3%, 434 points to the upside there. S&P 500, you're seeing that up 1.5%. The Nasdaq Composite up by about 1.75%.
Yeah, and guess what? One of the groups is it's doing quite well today. The regional banks. We got a comeback here. If you take a look at the Wi-Fi Interactive, here is the heat map of these regional banks, and I want to do it in equal weight so we can look at some of the ones that have really been falling a lot in recent days. I mean, PacWest, just to take one example, that stock is up 56% today. Look at it on the week, however, because it is still down quite a bit, but it is seeing a bounce back in today's session. Still no new news today about what, if anything, is going to be happening with it. Western Alliance, whether there's going to be a sale of assets or not, but we are seeing a bounce back. There has been reporting that we could, as soon as next week, get some new rules from the FDIC with regard to these banks, so we'll be watching that issue closely to see how that unfolds. Here's the KRE, the Regional Bank Index, or ETF, that tracks the index. That's up 5% today, and on the week, it's down 10%. We've got some great interviews coming up all day here at Yahoo Finance. Dan Halley spoke with a Microsoft executive on the future of artificial intelligence and the next innovation coming from the company. We've got that interview in the next hour.
Plus, the analyst who said Apple should buy Disney is back with her take on Warner Brothers Discovery. Rochelle Akufo is going to speak with Needham's Laura Martin in the next hour.
One of my faves. And stay tuned for our coverage of Berkshire's annual shareholders meeting, where we've got you covered all weekend. Saz is going to be having frozen mac and cheese and Coke and God knows what else. Rochelle Akufo has you for the next hour of trading. Have a great weekend, everybody.
You're live now from New York.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Happy Friday. Here's a look at what I'm watching so far this morning. All the tightening, not that much cooling. An upside shock on the jobs number, and over at Apple, iPhone demand holding up. A consumer stock's a good bet. We look to Berkshire and the greatest stock picker of them all. And it's the economy, stupid. So a complicated payrolls report for the Fed, but the White House doesn't want a recession anytime soon. We hear from one of the president's top economic advisors. And ignoring the doomsayers, you could fill a book with warnings over AI. Eric Schmidt making waves on that at this week's Milken conference. But Microsoft isn't backing down. We hear from them coming up this hour. But first, let's check in on the major indices here. We see strong gains here off the session highs, but still some strong buying action going on. The Dow there up about 450 points, or 1.4%. The S&P 500 also up about 1.5%, about 60 points. Tech-heavy Nasdaq off to the races, still riding that wave of the top and bottom line beat from Apple, and everyone's sort of keeping an eye on that employment data as well, coming in hotter than expected. Nasdaq up 205 points so far. Let's also check in on the Treasury market, as obviously we're seeing a lot more pouring into the tech space, which means more risk off. So we're seeing here the 5-year up almost about 4% on the day, 3.9%. The 10-year up about 2.6%, and the longer term 30-year up about 1.25%. Well, the U.S. economy added 253,000 non-farm payroll jobs last month, coming in hotter than analyst estimates. The latest employment data points to a resilient job market amid banking turmoil, rising rates, and elevated inflation. Here with what this all means for the U.S. economy, we have Thomas Simons, Jefferies money market economist. Good to have you on the show, Thomas. So I don't think any of us were really expecting it to come in. We were expecting a kind of a cool jobs report. Didn't get that at all here. I want to get your main takeaways and your reaction here.
Yeah, I think the data was somewhat mixed, but overall, you're right. This month's data was quite strong. Really, it's some odd downward revisions that we got to the February and March numbers that showed that it looks like the labor market started to soften then, but it actually picked up a little bit this month. I think when you look under the hood, there's a lot of encouraging signs in terms of the strength of the labor market. Some of the sectors that we saw job losses in the previous months eked out some modest gains. And a lot of the increases in payrolls that we saw were in sectors of the labor market that tend to be relatively high paying. So from the point of view of the consumer and the economy overall, it's a good thing. From the point of view of the Fed, as you mentioned at the top here, it complicates things. It makes it significantly more difficult for them to achieve their goal of getting inflation back down towards the 2% target.
And in terms of giving us some context into the types of jobs, you mentioned a couple of the sectors there. Strong gains in services. A lot of these were some of the harder hit industries due to the pandemic coming back. Is there a concern that it might be hiding perhaps some of these slower performing industries like manufacturing, which isn't quite seeing the same gains?
Yeah, manufacturing is having a tough time now. You know, we see in the monthly data, whether it's hard orders data or in the ISM surveys, that new order volume is down very significantly. You know, the consumer spent a lot of money on goods, durable goods specifically during the early days of the pandemic. They borrowed forward a lot of that demand, and now they just don't have a need to buy as much stuff as they did before. The manufacturing sector is still working through a lot of backlogs, however. You know, there's still tons of stuff that was in short supply back then that, you know, they're still filling orders. So there is current activity that needs to be addressed, and manufacturing is one of those sectors that tends to be relatively high paying as well. But what I was really thinking about more was in healthcare, in financial services, even in mining to an extent. You know, there's some good progress there, and the sectors that were most, hit the worst, I suppose, during the pandemic is really the leisure and hospitality sector. So a lot of food services and accommodation type employees. That's the only sector in the private sector that still has a gap between the current level of employment versus where it was in February of 2020. There's roughly 400,000 fewer people working in the industry than there were back then. Part of that, of course, is because their businesses were destroyed and that sort of thing. But also a lot of those people have moved out of that sector and into other higher paying jobs. It's one of the reasons why wages overall have been on such a strong trend throughout this recovery.
And we know the Fed also watching wages closely as well as this jobs report here. What kind of position does this put the Fed in now?
It puts them in a very difficult position because they have multiple things that they're trying to manage, and the strategies that they need to manage them are seemingly at odds with each other, right? So the biggest issue is at least as far as what looks like the near-term downside risk for the economy, is this stress in the banking sector. It's eventually going to lead to significant contraction in credit, it seems like, which could be a big problem for small businesses who borrow very heavily through regional and local banks in order to start up. We've already seen that start to take a hit on job openings. The JOLTS data earlier this week showed that small businesses pulled back a lot in job openings. But we're only sort of at the beginning of the process of seeing the labor market weaken such that we can get slightly lower wage growth that ends up, again, translating to lower inflation over time. At the other end is, and the strategy that the Fed needs to address this is continue to keep rates high for a while. On the other hand, you have these issues with the banking sector that are almost exclusively linked to the fact that rates rose so fast and so high. So, do you cut rates to save some of these banks or at the risk of having inflation reaccelerate? To this point, the Fed has decided to try to take a strategy with addressing the banks by the balance sheet through liquidity and loans, to the banks versus keeping interest rates high to try to slow down demand and inflation. So far, it looks like, the jury is out on whether or not they can do that and manage both problems heading in different directions at the same time with the same tools.
And then you add to that, you have a consumer who's been relatively resilient so far, but how long can they be resilient? When is that going to start to pinch with inflation and with the fear of recession and tighter lending conditions all sort of boiled into one?
Yeah, I think later on this year, it's really all going to kind of come to a head. So in the near term, it's really inflation that's still a big problem. The consumer worked through a lot of excess savings over the course of the last year and a half in order to try to keep up with inflation. Because obviously wage gains, though strong, are not as high as inflation was. They can only do that for so long. There's only so much excess savings to work through. And really a lot of that is concentrated in relatively wealthy people now at this point, too. Couple that with the fact that it's very likely that we're going to have up to 45 million people starting to pay back their student loans again later on this year, probably in September or thereabouts. That's a pretty significant hit to their, disposable income, and thus it's going to weigh on spending quite a bit. So I think as we get into that later part of the summer, we'll see more of the cracking in the labor market that, follows along with a slowdown in consumer spending. Because, U.S. consumers are extremely resilient, but they can only handle so much for so long.
Indeed. We knew the cracks would come at some point as inflation continues to be more persistent. A big thank you there to Thomas Simons there, Jefferies money market economist. Thank you for joining me this morning. Have a great weekend. Well, surprises all around this morning. Apple managed to beat expectations in the second quarter with a growth in iPhone sales. That is despite an overall downturn in the global smartphone market. Apple CEO Tim Cook credited this win to emerging markets like India, where the company sees plenty of opportunity for growth. Let's bring in Yahoo Finance's Dan Howley for the latest. Hey, Dan.
That's right, Michelle. India was really a central part of the earnings conversation from Apple, basically going on to discuss how Tim Cook had gone there. He'd spent time there. They opened the stores there. And that is, part of their strategy moving forward. Obviously, China is still a major part of their business, but India is increasingly going to be a piece of that. The issues that Apple have there, though, are many, mainly the fact that their devices are too expensive for most consumers in India at this point, though Tim Cook did point out that there is a growing middle class there who will be able to afford their devices. And so that's where they see the next major growth opportunity for iPhone. Outside of that, let's just go over the numbers real quick. We had revenue of $94.8 billion versus expectations of $92.6 billion. That was a beat. They beat on adjusted EPS, $1.52 versus $1.43. They beat on iPhone. They fell short on services, though, as well as Mac and iPad, though iPad just barely, and they beat on wearables. Now, the Mac iPad conversation, that really goes back to what we're seeing across all of tech, where people aren't purchasing computers. They purchased them during the pandemic. They don't need them necessarily right now, and they're expensive items, and people may be questioning whether or not they need them. Smartphones are kind of a different story. People will buy them more regularly. They're also, now that the pandemic is largely past, more essential to people's lives. There where a lot of people are going back to doing work on the go. So you're going to see iPhone perform better naturally than you would Mac. But I think one of the things that I just want to point out is throughout the big tech earnings season so far, the main word, or I guess letters, have been AI. And on the Apple call, Tim Cook didn't utter it once in his opening remarks. And the only reason he did was because an analyst asked about him, and it was only said 4 times. That's compared to the 30 some odd times we heard Satya Nadella, Sundar Pichai, the 20 some odd times we heard Mark Zuckerberg say it in their own opening remarks. Tim Cook giving that a big fat goose egg.
Seems that they're taking the wait and see approach there. You mentioned some of the softness, though. We talked about Qualcomm and some of their handsets and some of the shortfalls that they were seeing there. So what do you think is going to make Apple more resilient? Is that perhaps that they are focusing on their own chips? Like, why do you think they're able to sort of do better with handsets than some of these other companies?
Yeah, it may just be that, what we saw out of Apple was the really, really rough performance in Q1 as a result of the lockdowns in China. They weren't able to get the iPhones out. They said in this current quarter, they were able to manufacture to the degree that they wanted to, so there were no real holdups there. I think when it comes to the iPhone, though, I mean, you're going to get better sales overall just because there were some of those holdups where people weren't able to get access to devices. People are going to continue to go out and buy them. Now, when you start looking at Q3, Q4, Q3 is where you get the seasonality really coming in, because the next quarter or the end of Q3, beginning of Q4 is where you get the newer iPhones. So the September timeframe, really, when they start coming out. So they're predicting similar growth to to Q3 that they saw in Q2. What exactly that means, there was negative revenue growth, so there was decline year over year. We'll see how that really works out. But I think it's just, it speaks to Apple's ecosystem effect and its ability to keep people locked in. If you have an iPhone, you have an Apple Watch, you have AirPods, you're going to keep going back to your iPhone. You don't want to ditch it and then have to go to Android and figure something else out. So I think that's really a major part of the conversation.
Indeed. Great stuff there. Thank you for that update, Dan Howley, there for us. All right, looking at DraftKings surging in today's trading session after beating analyst estimates as the monthly unique payers came in better than expected. The company also betting on a rosier full-year revenue outlook as it saw significant increases in gross margin and adjusted EBITDA. CEO Jason Robbins saying the company is, quote, well-positioned to achieve profitability on an adjusted EBITDA basis in the near term. The stock there up almost 15% this morning. All right, coming up, all this tightening, not enough cooling for the Fed. The labor market ticking along nicely. This a good time to pick consumer stocks? We look to Berkshire and the greatest stock picker of all next. Let's do a quick check of the market sponsored by Flex Shares. Still seeing that buying action picking up here. The Dow now up about 445 points or 1.33%. We're seeing big tech really lifting all boats here. And especially that's why you see the Nasdaq now up more than 210 points or 1.7%. And all of the sectors in the S&P in the green, with energy leading the charge so far this morning. Well, it's been a tough week for oil and energy stocks. Crude is up today, but set to end the week lower. Ines Ferre is here to break down all the action. Hey, Ines.
Hey, Rochelle. Yeah, as you just mentioned earlier, energy seeing a bump today, a little bit of a rebound with WTI, West Texas Intermediate, up more than 3% right now. But if we take a look at the week, it's still heading for a third week of losses. As of yesterday, it had been down about 10% for the week. The S&P 500's Energy Select ETF XLE, it's a leader today. But if we pull up a 5-day chart, it's clearly the biggest laggard for the week, down about 5%. Now, this slide really has played out in tandem with the banking turmoil and concerns of a recession. We saw that as regional bank stocks came under pressure earlier this week, oil prices tanked. Now, another factor impacting prices this week is data suggesting that China's reopening isn't totally linear. China saw factory activity contract unexpectedly in April, reducing demand expectations. And China reopening, though, is broadly seen as bullish for oil. But make no mistake, if we continue to see continued pressure on the banking sector, this could have an impact on oil. Here's what analyst Tom Closa had to say to Yahoo Finance recently.
If we get a debacle in the financial markets, it will definitely have collateral damage in oil.
And on Wednesday, the Fed raised interest rates by 25 basis points. Now, that rise is expected to further put the brakes on the economy and reduce oil demand. And as we wrap up the week here, the latest jobs number beat expectations, still showing a hot labor market. And the expectation is that energy demand could stay strong. So overall, the selling that we saw earlier this week, it may have been a bit overdone. And that's why you're seeing the price action also on oil today go higher.
Indeed. And ending a tough week on a high note, at least so far. Thanks so much, Ines. Right, next, how to beat out Buffett. Berkshire Hathaway is set to kick off its annual investor meeting at Omaha, Nebraska this weekend. But for all the Warren wannabes out there, it's not just about picking intrinsic value stocks, but getting ahead of the crowd. Joining us now to discuss all things Berkshire, Jonathan Boyer, president of Boyer's Intrinsic Value Research and podcast host of The World According to Boyer. Good to have you on the show, Jonathan. So for people who are trying to get their heads around this, there obviously are some companies that don't have a market cap that Berkshire can invest in. So as you're looking at some of these small caps, if you want to be a baby Buffett, as it were, starting with the energy sector, how would you approach it?
Yeah, first, thank you for having me. Yeah, no, there's a lot of opportunities. Berkshire, because of its size, can't buy small cap stocks, and that's the cheapest area of the market. So individual investors have a big leg up on Buffett in that regard, as there are plenty of stocks selling at significantly below intrinsic value. As for energy stocks, that's an area we generally avoid. We don't like commodity-oriented businesses, but there are plenty of names in small cap land that we find attractive.
So give us your top 5 picks of the small caps that you find attractive.
There's a whole host of them. There's a company called Howard Hughes, which is controlled, or his chairman is Bill Ackman of Pershing Square. He keeps buying back stock. It's buying stocks personally. They own master plan communities. It's a great asset play. Company like Levi Strauss that's selling for 11 times earnings. It's rare to find a great consumer franchise that's so cheap. There's just, you can really literally run down a list. There's Madison Square Garden Entertainment, which owns Madison Square Garden itself and the Beacon Theater and a whole host of other entertainment assets. So there are plenty of names that are selling significantly below intrinsic value that big investors like Buffett can't buy, but most other investors can.
And so when you're thinking of the buy and hold strategy that Berkshire Hathaway tends to have here, can you still apply that same technique to some of these small caps as well, especially when you think of things like inflation and perhaps some consumer weakness that we might see at the end of the year?
Absolutely. I mean, I think investors should always think long-term, and buying and holding is a critical part of the investment process. You want to find great companies at great prices and hold them on as long as possible and allow the magic of tax-free compounding to work.
And so what are the benefits then of trying to look at some of these small caps versus just investing in Berkshire Hathaway if you're an investor trying to figure out how to play this?
Well, it's just a law of large numbers. I mean, Berkshire Hathaway is a make-a-cap name. How big can it get? I mean, I think it's a great long-term investment, but if you have a company that's a $2, $3, $4 billion company, it could easily be a 10x from there. But you have to find the right one. There are a lot of value traps there, so investors have to do their homework. They have to be careful and find stocks that they know and understand and buy them correctly and hold them, and hopefully things work out well.
And for people who are trying to get ahead of the game, perhaps before some of these companies reach the cap size that would be attractive to a Berkshire Hathaway, what are some of the strategies that you use, any kind of formula that you use in really picking a good value stock versus one that's cheap but not necessarily going to go anywhere?
Well, it all comes down to the business. You know, is it a good business? Do they have a product or a service that people want? And can it grow? Is there a large total addressable market? And then it comes down to valuation. Are you buying it at a cheap enough price where you have a margin of safety? So it's whether you're analyzing a big cap stock or a small cap stock, it's the same way. Price is critically important, as is business quality.
And obviously you're there in Omaha. We're wondering what your expectations were, what you're hoping to hear from Buffett and Munger this year.
I'm really looking forward to hearing what they think about the regional banks, about the banking system in general, and I would love to hear why, of all the banks that they kept Bank of America and left, really sold all the other ones, and I'm curious why. I wonder if someone will ask him that question directly.
And in terms of succession plans, do you think we'll hear much about that? And in terms of the front runners there, who do you think would be best to carry on the legacy or perhaps change a bit of the direction of Berkshire Hathaway?
Well, I mean, I think the succession issue is pretty much decided. I mean, Greg Abel is there. They have a great team in place. And Buffett has done something really unique. I mean, he's built a company that could last for, decades and decades. And it could, I won't say it runs itself, but it's a conglomerate. And I think it's going to be a great company for many years to come.
Well, certainly his strategy has worked for him so far, a success at Berkshire Hathaway. A big thank you for joining us. I hope you enjoyed the conference there. Jonathan Boyer, president of Boyer's Intrinsic Value Research and podcast host of The World According to Boyer. Thank you so much.
Thank you very much.
All right, you're welcome. All right, coming up, ignoring the doomsayers. You could fill a book with people's warnings over artificial intelligence. Eric Schmidt making waves on that at this week's Milken conference. But Microsoft isn't backing down. More on that next.
Is it evil? Can it switch from good to evil? Can it confuse me? Could it decide to not tell me what it's doing because it learned to be deceptive? Did it read a book that told it, a spy novel where it learned how to deceive me? I don't have any context for that. So we're going to have to develop a theory of mind for these new systems, and it's going to be different. They're not human, they're not conscious, they're not copies of human brains.
That was, of course, former Google CEO Eric Schmidt there speaking with us at the Milken conference this week. Schmidt is a big proponent of AI, but has been clear on the specific use cases for the burgeoning technology. Well, one tech giant not slowing its roll on adoption is Microsoft. It's doubling down, announcing yesterday its AI-powered Bing chatbot is getting a major features upgrade. The new additions come with Bing Chat opening up fully to the public. Yahoo Finance's Dan Howley sat down yesterday with Microsoft's Corporate Vice President of Modern Life, Search and Devices, Youssef Mehdi. Take a listen.
This is a big day for us. We're announcing what I think of already as the next generation of AI-powered Bing and Edge. It's only been 90 days since our original launch. The thing we're trying to tackle is the notion that half of people's searches are going unanswered. Today, we think about the next generation really having about 4 elements to it. One is we're moving from a limited preview to an open preview, so anyone now can come and use Bing. Second is we're moving from really a text-heavy interface to one now that is really rich in multimedia. So it's got images and videos. So when you ask questions and you chat, we can actually answer with images and videos. The third is that not only is it a kind of a one-time use, but now it's becoming really more of a full-fledged productivity tool. So we now save your chats and you can keep them. So if you're doing research over multiple days, your chats are there. If you want to share them, we now provide an export and share feature so you can share with friends and family to collaborate. And we actually do it nicely within Edge so that if you're chatting and you find a link that you want to go explore, we keep your chat persistent on the right side of the page while you're looking at that web page. And then the last big change is we're moving from just an individual product to a platform. So now third parties can write plugins to make the experience better. So for example, I was using Bing Chat yesterday to find good restaurants in New York to go eat after the work I was doing. And now OpenTable can fire in that window. And with one click, I can go ahead and book the restaurants I find with OpenTable. So that's an example. Those are the 4 things that we're doing, building on top of the great progress we've had with Bing and Edge to date.
So at some point I would be able to say, okay, plan me a trip to Hawaii. And it would, if there's a plugin available or the developer puts it in there, I would be able to essentially do that whole workflow through there.
Correct. So you'd be able to, basically call, for example, a travel plugin, and then it'll be able to automate that task. It might probably likely go to the travel site, but all of that research and context that you were doing will transfer over with you. So it'll really simplify the process.
All right, I just want to get to some numbers real quick. There was mention of daily average users. What are you seeing on Bing so far, and what kind of searches are people primarily doing?
Yeah, so since we've launched the new Bing, we have crossed the big threshold. We're now over 100 million people who use it every day. That's a big number, but it's obviously very small relative to the overall market. We're probably still just single digits in terms of usage. The big thing we're learning is chat is what everyone's really excited about. Chat is the big thing that's transforming the experience. We've had over 500 million chats since we've launched in 90 days. And within those, we've had over 200 million images created because you can now just use your words and text to create images. The thing we're learning is people are really using chat to search. About 70% of what people are chatting for is things that you typically find in a search engine, in a search session. And so the transformation of search is definitely underway.
I guess, when you look at the next steps, where do you see Bing going? And I guess, you talk about the single digits as far as market share. Is the goal to continue to creep that up? I know there was talk that I think Microsoft had put out numbers that each % of market share equates to about $2 billion in revenue. So is the idea to really kind of transform this and become the de facto leader in the search space?
Well, as you point out, the search category, we should say first off, is the largest software category in the world. And as you quoted, correctly, it's about $500 billion. So 1 point of search share is worth quite a bit. For us, we don't need to completely change the world. If we can even grow a couple points of share, that is a very big deal for us as a company, and really more importantly, it's a big deal for consumers because it'll bring more competition, it'll bring a new experience, and that's what we're focused on. And we're having some good success thus far. Edge share has been growing over the last 8 quarters in a row, and since the launch of Bing in the last 90 days, we've finally, for the first time, seen Bing share just begin to grow. It's small, but it's now growing.
And you're opening up to more people. Obviously, that's going to help expand that even more. So I guess, the biggest rival in the 800-pound gorilla in the room here is Google. They're going to host their I/O developer conference. Is there fear that Microsoft and Google are getting into an even greater race? How does Microsoft kind of assess that threat that it may pose to Google?
Yeah, I mean, for us, the way we think about it is we're really in an enviable position. That search is needing a disruption. We're a very distant player, as we just talked about. We have great new ideas. We're a first mover in this market, and we're not struggling with innovator's dilemma. We can go and change the nature of search, and we can run fast on that and do it well. And I think that's beneficial for us. It's tough for a few of the incumbent, but I think at the end of the day, the consumers are going to benefit from this. Increased competition.
And just as a final, I know the White House held a meeting today with Satya, Microsoft CEO Satya Nadella, as well as Sundar Pichai over at Google and others in the AI space, just to discuss legislation, potential legislation, and kind of what AI guardrails need to be put in place or don't need to be put in place as far as innovating on the technology. I guess, how does Microsoft view that? If Satya is taking part in the discussion, obviously it's got to mean that he's on board.
Yeah, absolutely. I guess I would start by saying, first off, our top priority before we even focus on product features is to make sure that we're doing responsible AI technology development. That's at the center of what we do. We publish now for many years a set of principles upon which we do technical development that touch on things like transparency of information, safety of information, making sure that technology is inclusive of people. And we grade all of the work that we do against those principles before we release it. Then we do a bunch of technology work, enhancing special work to protect against safety and guardrails in it. And then ultimately, it is about bringing it to the market, like we've done with Bing and with Edge, to get user feedback, because we believe you need to do this out in the public. People need to be able to see it and use it and critique it, as opposed to have it be done quietly in the lab someplace and then just flip a switch. And one of those important things is working with governments and regulatory bodies, which we also believe play an important role to make sure that the technology is safe and accessible for people, protective of kids and the like. And so we are absolutely happy to participate in those dialogues and do the work we can to bring this great technology to the world.
That was Yahoo Finance's Dan Howley there with Microsoft's Corporate Vice President of Modern Life Search and Devices, Youssef Mehdi. All right, well, coming up, it's the economy, stupid. A complicated jobs number for the Fed, but the White House doesn't want a recession anytime soon. We hear from one of the president's top economic advisors next. The US labour market showing surprising strength as it adds more jobs than expected in April, while the rate of unemployment edges lower and wage pressures remain. Then adding to the mix is elevated inflation and lingering recession concerns, painting a multifaceted picture of the economy. Here to dissect the several facets at play for the US is Deputy Director of the National Economic Council, Bharat Ramamurthy. Thank you so much for joining us on Yahoo Finance this morning. So we did see with this really unexpected jobs number here, the president taking a victory lap here, tweeting that 12.7 million jobs since he took office. What are your biggest takeaways from this jobs report, and especially when you think of where we were in the thick of the pandemic?
Yeah, it's another very strong jobs report, one of several in a row at this point. I feel like every time I come on after a jobs report, we're talking about how we're beating expectations. And I think that's really the story of this economy. We've been beating expectations now month after month, year after year. To me, the headlines are 3.4% unemployment, the lowest since 1969, 50 years plus. The lowest black unemployment at 4.7% that we've ever had in recorded history in this country. And all of that power in the labor market alongside the fact that annual inflation has come down now for 9 consecutive months. So overall, I think a very strong picture of where the economy is.
And as we look at how the jobs have been spread across the sectors, we did see a very strong showing from the services sector and a lot of the sectors that were hard hit by the pandemic. But how evenly distributed should this be at this point?
Well, I think that month to month you're seeing different sectors of the economy show strength. And one thing that we've liked to highlight is that the manufacturing sector overall, since the president has come into office, has shown incredible strength. 800,000 jobs created in manufacturing out of the 12.7 million created under this president. And I think a reflection of the president's economic approach, which is to build more things here, to move as much of our supply chain onshore as we can so we're not as vulnerable as we were during the pandemic, and in the process create really good, high-quality jobs.
Obviously, this is coming at a time when we're still in the thick of high inflation here, core PCE still high. The Fed now having something of a balancing act here. Is it going to take a recession, though, to get labor force participation up to pre-pandemic levels?
Well, actually, prime age labor force participation has exceeded pre-pandemic levels. Workers ages 25 to 54 are being attracted back into the labor force because it's a great time to get a job. Wages are going up across the board, particularly for those folks at the lower end of the income spectrum. And as a result, you're seeing people come off the sidelines and get into the labor force. We think that's a very positive story.
But for those outside of that bracket, it's still below pre-pandemic levels at the moment.
Well, sure. If you look at folks who are getting up there in age, maybe it hasn't recovered quite as much. I think in part because overall there's some financial security there that means that they don't need to get back into the labor force. I think that's actually a good story to tell. But I think if you look at prime age workers, overall the story is very strong. And to get to your other question, no, we don't believe a recession is required to get the labor market back into check. We've already brought inflation down significantly over the past several months and at the same time added jobs. And I think we can continue to see that balancing act over the next several months.
Now, something else that's also coming up, a couple of debt ceiling scenarios. We saw that the White House laid out some possible projections as to the impact on the economy if it comes down to brinkmanship versus a short crisis or longer, short default or protracted default here. When you look at some of these figures here, though, I mean, do we have an idea about what is the most likely scenario at this point?
Well, look, it's Congress's responsibility, as it has been for decades now, to address the debt ceiling and take the possibility of default off the table. As you noted, the Council of Economic Advisors did an analysis of what would happen if we defaulted. And in basically every scenario, it's devastating. We're talking about an immediate recession. We're talking about millions of job losses. We're talking about interest rates spiking and higher costs for mortgages, for credit cards, for small business loans. It would undo a lot of the incredible progress we've made over the last 2 years. And it's completely self-inflicted and unnecessary. It's a crisis provoked by House Republicans who are threatening to default unless they get their extreme partisan agenda, massive spending cuts to programs that working families rely upon. And that's why the president has been clear. Let's take the possibility of default off the table. And then he's perfectly happy, just as he did last year, to have a conversation with both Democrats and Republicans about tax policy and spending policy in our budget.
And we know the president will be traveling shortly. So in terms of the number of days to get this done, a deal done by the X date, are we looking perhaps at not seeing this done? I mean, we know that this debt ceiling has been raised every time since 1960, 78 times been raised. Is there a scenario where we don't meet that X date?
Look, it's Congress's responsibility to get this done. As our OMB director said yesterday, it would take about 5 minutes to write a bill and put it on the floor of the House of Representatives that took the possibility of default off the table without conditions. We could pass it and get it done and begin those discussions about our two different visions for tax and spending policy in this country. The complexity here is not getting the debt ceiling raised and taking default off the table. It's that House Republicans are trying to use the possibility of a global economic crisis as a bargaining chip to ram through spending cuts that are wildly unpopular and that will be devastating to the economy.
And obviously this is coming at a time the Fed is trying to balance what it's doing to, hone in on the bank crisis, get some financial stability going. So in terms of your economic outlook for the rest of the year, I mean, the consumer can only hang on for so long with inflation still so high. What is the economic outlook that you're seeing for the rest of the year?
Look, I think we need to get past the possibility of default, take that off the table, remove that uncertainty that is clouding the economy right now. Again, we think that the latest data that we have shows an economy that is in extremely strong shape with a lot of new investment coming down the pike. Remember, the infrastructure bill that the president passed into law, the Inflation Reduction Act and the clean energy tax credits that includes, the CHIPS Act, which is going to provide new investment in American semiconductor manufacturing. A lot of that is still to come. And as that investment hits the economy, I think we're going to see continued economic tailwinds.
We'll certainly be tracking that. We do thank you for joining us this morning. Bharat Ramamurthy, Deputy Director of the National Economic Council. Thank you for your time this morning. All right, time now for today's chart of the day. And we're looking at big tech. While tech giants Microsoft, Apple, Alphabet, and Amazon have been successful, Microsoft's long-term performance has been particularly impressive in comparison. As you can see, these companies' IPOs, Microsoft has outperformed in terms of share price. Since going public, Microsoft's stock price has risen to over $300 per share as of May of 2023. With a diverse product portfolio, enterprise software dominance, and investments in AI. One can only assume Microsoft's growth has more room to run, although it did have an earlier head start, as we can see. Right, coming up, the ad market conundrum. That tough economic environment weighs on Warner Brothers Discovery's revenue, but it says its streaming business will become profitable and soon. We discuss how next.
We are on track to achieve this year's financial targets. And we see a number of positive proof points emerging across our businesses, with direct-to-consumer perhaps the most prominent. We have strong command and control of our DTC business. We made a meaningful turn this quarter, generating $50 million in EBITDA and adding 1.6 million new subscribers. And we feel really good about the trajectory we are on.
Warner Brothers is now expecting that division to be profitable as soon as this year. Now, that's despite concerns about streaming competition and inflation. Still, the company posted a big loss in the first quarter, and investors are looking for more from Warner Brothers. CEO David Zaslav Joining us now to help digest this tough quarter is Laura Martin, Needham Company's Senior Media and Internet Analyst. Good to have you on the show here, Laura. So I want to first start with Warner Brothers Discovery there. Are you as optimistic? I mean, you have a hold on this at the moment.
Yeah, so they're making really good momentum. The cost cutting here is world class, and they're saving. They keep raising the estimates of how much they can save in cost cutting. And their next focus is going to be on the film segment, which I think there's a lot of excess cost there. So I think what's happening in all these businesses is we're bringing a really disciplined cost cutting umbrella into what was traditionally in Warner Brothers under AT&T sort of monopoly cost structures, which are typically inflated.
And do you think potentially this could be something attractive that Apple could be looking at to buy?
You know, we're arguing that Apple should buy the Walt Disney Company. The issue here is I think we have a broken film content creation engine where Disney, the company, it is not broken. But here at Warner Brothers, it's unclear they can actually make like DC comic movies. So Batman has been successful. They're going to launch another Superman. So we'll see. But the Warner Brothers Film Studio has been sort of on a cold spell for the last 5 years, and Apple can't help with that. Apple's a distribution platform, so Apple would really need to buy a successful and healthy film studio to make content, not a broken one.
And so then what would be the biggest selling points in terms of the synergies that you already see between Apple and Disney?
Apple and Disney. So the great thing, the brand consistency, right? World-class brands in both cases. You'd be adding 100% omni-channel touch points because you can touch consumers in theme parks, which Apple can't do. And then you would also have 2 billion active devices in Apple. You could do some of the content of the Walt Disney Company exclusive to Apple for a certain window, 3 months or something, which would drive Apple iPhone penetrations. So there's a lot of synergies always between distribution, which is what Apple iPhones are, and content, which is what Disney is. So yeah, we think that's an interesting, but WBD does have a big library. I think it's still in the turnaround phase. We expect WBD to look at Paramount as an acquisition. You know, they reported their stock was down over 20% yesterday. And Warner Brothers is just managing the same business better than I think Paramount is. So that's the one I think Warner Brothers should buy.
So then in terms of the biggest upsides you see for Warner Brothers, especially in such a competitive streaming space here, what are your top upsides for them?
So one of the things they said that was new is that HBO churn is really high, but Discovery Plus churn is really low. And recall that Discovery Plus is all of that, let me call it super fandom content like Love It or List It or the Fixer Uppers. So I think putting those two services together should lower churn, bring more fandom, which should bring more pricing power. And you would have the upside of that really high quality HBO Max content. So it could arguably be the most powerful streaming company. We'll see. It always has held that promise and so far hasn't. But now we have it in the hands of a new CEO and a new marketing team. So maybe they'll be better. But I would say that's the biggest hidden upside value driver potential is that HBO, what they're now going to call Max, with that full line of content becomes as sticky and as popular as Disney or Netflix.
And we knew that we were going to hear a lot about ad spend coming into this earnings season for big tech. Meta, certainly surprising in that regard. How do you see the ad spend story for this earnings season in big tech?
So advertising was down like 15% for Warner Brothers in North America. So I would say the connected television ad market is weak right now, as evidenced by Roku, and Fubo just reported weak ad revenue. And this one, Warner Brothers and Paramount, weak ad revenue, down double digits. So in the connected television glass, that ad unit, those are weak. To your point, some of the Google, so Alphabet and Meta had better advertising numbers than they have, like the momentum is turning, but that's a smartphone ad unit. So it's sort of different than, and remember, smartphone ad units sell round numbers at $2 cost per thousand, and connected television ad units sell at $20 cost per thousand. So you really have a disproportionately negative impact on advertising growth if what's weak is the connected TV ad market because of the higher cost per thousand.
And so obviously we saw a lot of money and a lot of investors pouring into big tech, despite what they were hearing from the Fed about, not pausing anytime soon. Now you have this sort of a good jobs number, although it puts the Fed in a tough space. What's your outlook for tech then, based on what we've already seen this earnings season, even though the expectation, the bar was quite low, but we kept hearing about those macroeconomic concerns still lingering?
I got to tell you, these Apple numbers yesterday were, as the biggest of the big tech, Apple's numbers were excellent yesterday. Not only did they generate $28 billion of free cash flow, but they grew on an FX adjusted, so currency neutral basis. They grew revenue at 2% out of emerging markets. They really exceeded everybody's iPhone estimates, all from emerging markets, places we never think of as having Apple relevance. So I think that's really interesting. And China's coming back. So China, was locked down for a lot longer than the US and Europe. And now demand is starting to come back. And it used to be 20% of total iPhone demand, and it's starting to come back. So that could actually drive sort of the upside to the Apple story for the next year or so. So I would say Apple among big tech is a good place to hide because it doesn't have any ad revenue. It just has a 2 billion active device installed base of some of the wealthiest consumers on planet Earth.
Certainly not a bad spot to be in if you're Apple. A big thank you. Always great to have you on. Laura Martin, Needham Company Senior Media Internet Analyst. Thank you and have a great weekend. Right, now to a key development in the birth control debate. Shares in pharma group Perrigo falling after US regulators raised concern over its suitability as an over-the-counter drug. Yahoo Finance has reached out to the company for comment. Anjali Kemlani joins us now with the details. Anjali.
That's right. So we know that the FDA has been set to look at AAPL, that's the birth control of Perrigo, and that is something that would make it the first over-the-counter available pill if it goes through. Now, the FDA has raised some concerns in documents released, and that looks at things like compliance, whether or not individuals, especially in the younger age group, teens, are likely to follow the correct dosage and requirements and take it on time, as well as concerns about weight gain, which has actually traditionally been one of the concerns with oral birth control. So that's one of the things that is going to be coming up. The FDA is saying, especially because of the concerns of obesity in America, that is one of the things they're going to be looking at. So all this comes to a head next week, and that's when we're likely going to get some more information and see just how it all pans out. And this, of course, comes in the wake of the overturning of Roe v. Wade, which is when the company put forth the application. It has already been available and approved for prescription, which is how most birth control is received, but then this would make it the first to be available over the counter.
And we certainly were expecting that after the overturning of Roe v. Wade, to see how some of these domino effects on contraception and birth control would continue. A big thank you there, our very own Anjali Kemlani. Thanks so much. All right, well, that does it for now. As we can see, though, heading into the noon hour, all green across the board, all major indices still bouncing around those session highs. That'll do it for now. I'm Rochelle Akufo. I'll be back with you at 11 a.m. Eastern on Monday. See you then.